Airlines and aircraft makers are desperately searching to reduce their climate impacts. CO2 emissions amount to about 2% of the global total and 7% in the UK, and are increasing. But there are other impacts, such as the damaging contrails. Back in 2011, I was granted a patent for a novel way to generate power and hydrogen from hydrocarbons. Highly efficient fuel cells and electrolyzers make this possible. Using this patented process as a front end to a more conventional gas to liquids process, we can turn all sorts of worthless waste into high-value fuel, help clean up the environment, and solve the problems of disposal in one fell swoop.
Making sustainable aviation fuel in sufficient quantities is a massive chemical engineering challenge. We've already started building our bench scale system, which will just prove the concept. So we'll take some waste, which is our feedstock, and we'll create some fuel to demonstrate that the process actually works. The key step is then our demonstration system, which will be a 5,000 tonne per year plant, and that will be a very faithful reproduction of the larger scale plant that we're going to scale up to. Then we're going to scale up to our 30,000 tonne per year commercial plant, where we're making fuel, selling the fuel and making money for the business. Jet fuel is a tightly regulated product. In our case, we have to meet those requirements, but we also have to meet the requirements that it's sustainably produced.
Reducing global temperatures and protecting our planet is a key generational challenge. Our mission at Aviox is to deliver the world's most technologically advanced refinery making sustainable aviation fuel. We believe that the plant will be highly profitable due to the very low cost of the waste materials as input material. We need the resolve and the capital to make a radical shift within our economy to make it modern, circular and sustainable. This is a once-in-a-lifetime opportunity to join a new wave of clean tech companies developing clean, green and sustainable aviation fuel, and it's a privilege to be part of it.
Well, thank everyone so much for coming in. I know people are still getting settled, but we'll start getting the ball rolling here. Nice to meet everybody. After a fantastic morning session on the policy in the UK, we're going to have a bit more of a conversation around the investment and final investment decisions that we're seeing in the SAF space. My name is Oliver Booth. I'm a research associate with Sightline Climate, where we conduct deep market intelligence research across all things climate tech. I lead our low carbon fuels and sustainable aviation fuels research, and excited to chat to you a bit more about what it looks like to get some of these projects and some of these companies from the early venture stage all the way through to debt financing for first-of-a-kind facilities. And to do that, we've got a fantastic panel here. We have Martin Freeman from Sumitomo Mitsui, Shambhur Gupta from Clean Energy Ventures, Oliver Phillips from Barclays, Susanna Hinson from the House of Commons, and Mathangi Chandrasekhar from Gresham House. I'm going to invite everybody up now. And while they're getting up, just set the stage a little bit. One of the things that we notice in the sustainable aviation fuel space is that it's a really early stage space. With the possible exception of HEFA-based biofuels, made by large oil and gas companies, 80 or 90% of the SAF projects that have been announced are still in that announcement phase. They're not hitting the final investment decision necessary to start actually producing fuels. But in order to hit these targets and in order to decarbonize aviation, we're going to have to actually start producing fuels. These announcements will only get us so far. So just the main purpose of this conversation is to start thinking about, well, how do we get from where we are now with a whole bunch of announcements and exciting companies at the early stage, all the way through to actually being able to put some fuel in the back of an engine. So to get started, I'm just going to go down the line and have everyone introduce themselves and talk a bit about where they're approaching the sustainable aviation fuel space from. Oliver, start with you. That's not working.
There we go, it is on. Look, great to be here today and great to see so many people turning up. I think, really shows the depth of interest in SAF in the UK, which is brilliant. So I run Barclays Sustainable Finance business, actually for the Middle East and Africa, based over in Dubai. So slightly surprising for some people that I might choose to be here today. But one of the things that Barclays is very much focused on is really how do we kind of drive the energy transition. Very much focused from a technology point of view. Really thinking about how do we bring innovative technologies from idea all the way to IPO, supporting on the sort of the financing journey along that journey. And I spend a lot of time with companies that we've actually invested in ourselves. We do some of our own earlier stage investing, and then also the clients of our investment bank, thinking about how do they raise capital from particularly the Middle East, how do they deploy their projects, their technology into the bits of the world that I look after. So I'm here really today sort of thinking about from that kind of probably later stage capital and how you get projects sort of shovels in the ground type thing going.
Okay, Martin.
So hi everyone, my name is Martin Foreman from Sumitomo Mitsui Banking Corporation. So I cover also Europe, Middle East and Africa, but from a debt perspective. So I would probably come also at a later stage largely. Sumitomo comes usually as a senior lender to these big projects. We're looking at also potentially mezzanine, but I don't think that it's going to be a chunk of money coming on into the SAF plants. In general, I cover carbon capture and storage, hydrogen, all type of colors except gray and brown, or the dark colors as I call it. And then biofuels and H2 derivatives, which includes also e-fuels. So it's quite exciting, and I think that the SAF and biofuels have the stage now, what probably hydrogen had a year or 2 years ago. So I'm really looking forward to see some SAF plants coming to us. Yeah, thank you.
Hi everyone, I'm Shambhur. I'm with Clean Energy Ventures. We're an early stage, at around a VC firm focused on the seed, Series A kind of stage. Really climate focused. We have one of our core investment criteria is around potential emission reduction potential that our investments can have. We tend to be more technical in nature and really, we've made an investment in SAF, for example, but we've looked at things across the energy value chain, advanced materials, heating and cooling, things like that as well. So I just moved to London as of last week, so yeah, just still getting used to it. But great.
Thank you. I am the odd one out on this panel, the token policy person. I lead on energy policy for the House of Commons. But the reason I find myself on an investor panel is probably because of my previous role. I used to head up the emerging sectors team for the UK's Green Finance Institute. We did a lot of work with the Department for Transport, Breakthrough Energy, investors, developers across the UK, looking at how we could finance those first-of-a-kind SAF projects within the UK. So happy to shout out that great team, if I do say so myself, and talk about some of that work on this panel. Within my current role in Parliament, as I said, I lead on energy policy. Not many people have heard of the research service because it works mainly for MPs, but a lot of our publications are available for the public if of interest. And there's a lot of really interesting parallels between other sectors that have scaled across power and energy and what we can learn about trying to scale the SAF sector in the UK. There's two caveats that I have to let you know about being on the public sector side of this panel. The first is I'm not the government. If you have any questions about policy, when the legislation is coming out, or any complaints about existing policy, you need to go and find Hazel and talk to her. I cannot fix them for you. And second, as a civil servant, I have a requirement to impartiality. So I will have to try and keep my opinions in check on this panel. Hopefully Oliver won't make it too difficult for me. And if you do hear anything that sounds like an opinion, it's very much my own and does not represent the House service.
Wonderful. That's a very exciting job that you do. Mine is not that exciting. Well, my name is Matangi. I'm from Gresham House. We're a sustainable infrastructure fund based in London. As I was explaining to the guys here, that we're an umbrella of funds that have different strategies, including forestry, grid, and then comes the sustainable infrastructure piece, which is the fund that I'm part of. We are a real assets-focused fund with a core focus on sustainability. We have 6 verticals that define our investment thesis that range from decarbonization, regeneration, resource efficiency to waste solutions. And these 6 pillars really cover everything under the sustainability gamut. So we could fit absolutely anything that's green and has a positive impact on people's lives under our investment thesis. Our exposure to the SAF ecosystem really comes from 2 of our assets that we have. One is a used cooking oil recycling business. We're a collector and recycling business, which feeds into biofuel plants as well as, hopefully, in the future, SAF plants in the UK. The other business that we have is a SRF pelletizer business that, again, currently supplies these SRF pellets that are coal replacing pellets to lime kilns and cement kilns, but can also be used in the gasification process for SAF production. So that's where I think our interest comes in the SAF ecosystem, and we're keen to see the advancements that are happening in this ecosystem.
Great. So there are a lot of companies sitting at a lot of different stages here, and including in the room, that are sitting all the way from kind of pre-seed stage all the way through to they're thinking about building their plants now. So one of the things I wanted to do was kind of walk up the capital stack of this space from the kind of seed stage all the way through to kind of thinking about actually building these plants. So I think the easiest way to do that is to start at the beginning with Shambhor, talking a little bit about what the kind of clean energy venture strategy is. So you made an investment in OXCCU, which is very exciting at that kind of seed Series A type location. You can talk about that specifically, or just generally on how you think about the kind of key considerations for investing at with a company that is at the stage of an idea and an early prototype, maybe if you're lucky, but is miles away from actually kind of building these plants and making money.
Yeah, quick shout out to OXCCU. I think they're in the back there. But I think for us, there were, at least when we look at the space, because as you said, Oliver, that we're, it's still very early days, and you try and go back to like first principles of, where do we see the different technology pathways, whether it's HEFA or FT or ATJ, et cetera. What's the lowest cost kind of pathway that we see? So cost is one major dictating factor, and the cost floor that we see. The other is, I'd say, scalability and limits to scalability, I'd say broadly. So whether it's around feedstocks, whether it's around deployment and sites or certain specificity, that's another kind of lens. And I think there are 2 others that I do want to highlight that probably don't get enough coverage. One is the ability to build a syndicate of partners. So, as an early stage fund, we only have so much that we can do in terms of, it's great, we can provide dollars and we can provide some support for scale up, but it's really around large strategic partners who can, then take technology, implement it, find sites, help with pilots, build out a pipeline of projects. That's one aspect. And then, of course, we have to look at the regulation kind of regulatory landscape, I guess, and where it's trending. We don't want to make bets on whether positive legislation happens or not, but you do need to be aware of it. And so those are, I think, the 4 main dimensions, at least how we see it. And of course, it has to be an outstanding team.
Well, having met the CCU guys, they are an outstanding team, so it's exciting work from them. And the next stage of this kind of process then is thinking about the infrastructure investments and those early facilities for either a kind of commercial scale facility or a smaller kind of demonstration scale facility. I think I'm curious, what makes for a good infrastructure development? How do you think about balancing that, the risks associated with this being a first of a kind, with the opportunity of it being a first of a kind?
I mean, we've actually dabbled with some of, cutting probably the first institutional check or the first check even to businesses in our portfolio. So I think what we do to answer the question on how we manage the risk, I think is actually manage that with portfolio construction internally. So we will have a mix in our portfolio with assets which are, very early stage, just an idea stage, with assets that are slightly, later in the game. So that's really on us to kind of balance the risk, in our portfolio. But in terms of what really makes for a, good investment, from our perspective, I mean, it goes a lot with what, Shambhu just said. I think it has to be, a good team, definitely. I think from a technology perspective as well, it has to be a future-proof technology. I think given how quickly things get obsolete, we want to make sure we're investing in the best technology or the winning technology potentially. So I think that's something we look for. And the third, I think it feeds back into our core thesis of impact and both from a quantity as well as quality of impact. So whether it targets a large enough market, and this is slightly more generic and just outside of the SAF ecosystem also, but just targets a large enough market and has, as the quality of impact is also quite significant. I think just other than that, I think we're also looking at scalability because if you look at the investments that we've made, we look to invest in platforms, not just single assets. So whether this technology being future-proof is also scalable so that it's not just one plant and it's multiple plants that we can fund. So I think these are some of the factors that kind of feature in while we evaluate businesses. But I think the fundamental being that it needs to be future-proof technology.
Yeah. Well, so we've got a great team that's built out. We've got a future-proof technology. The next stage is how do we think about securing equity financing for some of these early first-of-a-kind facilities? Someone comes across your desk, what are the kinds of key considerations that you're thinking about?
So I think the 2 things to think about is sort of kind of more growth equity at a top co level, and then looking at project equity separately. And I think that's sort of the requirements there are going to be slightly different. If we're looking at more the sort of the corporate level growth equity, and we're really looking at a company that's proven that its technology works, that's de-risked it as much as possible, probably going to be talking about someone that's already got a pilot up and running. I think one of the things that I hear the most from particularly investors where I'm based is, well, this pilot is great, but it's just a very, very reduced version of the real thing. It's not a shrunk down sort of full model. And it's a slightly complicated thing to get your head around, but what they're sort of saying is, well, you need to make sure that your pilot shows that you can actually scale this up. And I think really thinking about how you can make sure that through that pilot project you're demonstrating that you've actually learned enough to deploy this at scale is very different to saying, how do I get a pilot to work? And being able to sort of navigate that, I would say, very blurry line between the two is something that I certainly can't do, and that's why I'm a banker and not an entrepreneur. But I think that's when we see the sort of the easiest sort of kind of growth capital raises. That's something that's certainly happening. I think being able to show that you've made some progress towards also delivering that project. So progressing on the partners that you're going to bring in, any off-takers, any people you're going to be selling to, and also I guess doing some of the groundwork is going to be key. And all the rest of the reasons that have been mentioned for the early stage stuff still apply. Then if you look at the project level equity side, it's a little bit different because you're almost taking a bit of there's much more, if you're a new investor coming into this, there is that greater element of risk because if this one project doesn't work, you're stuffed. If you come in at the top co level, there should be a portfolio, and similar to how Gresham is managing its risk, it's a similar sort of thing to think about. So really, what I see, and I think this applies for a lot of different climate technologies. I remember saying this about green hydrogen projects about 5 years ago on a similar panel to this. But it's really thinking about how do you build that right consortium to develop your project? How do you make sure that you're bringing the right people in to sort of mitigate as much as possible all of the different risks and challenges that they're going to come across? When you're looking at bringing in what I'd sort of say is more financial equity, by that point, ideally, you should probably try and have some sort of corporate or strategic equity in there as well from those other partners of your consortium. So thinking about, can you bring in, the person who's going to be your off-taker, can they actually provide some equity as well? Maybe, there's some of the technology suppliers. Is there a way to bring them in as well? That will make it easier to attract those financial investors who, let's be honest, are not going to have that same level. Some of them will definitely say that, but they will never have that same level of understanding as someone that's on the technical side doing this day in, day out and delivering this. So it gives them comfort that not only are they committed through the contract, but they're actually putting their money where their mouth is. And that's obviously sort of the pre-FID equity that I'm really talking about here. And I think I'll pause there.
Well, we sort of walked up the line of equity, and as anyone who's tried to build a huge facility can attest to, the cost of capital racks up pretty quickly when you're dealing with predominantly equity financing. So, Martin, I wanted to move to you to talk a little bit about your considerations when thinking about debt financing for these early facilities. It's one thing to be raising equity financing at an early stage. It's another thing to be raising debt financing at a late stage. But that transition there of maybe this is the first large-scale debt financing they're able to secure, I'm curious how you're thinking about key considerations for feeling confident in making those kinds of decisions.
So it will go the same way. Everything that what my colleagues said applies, and it becomes a little bit more even stricter what we require as a senior lender. So I would be usually sitting on a non-limited or limited recourse financing. I put the corporate debt a little bit aside. So I don't think that there is a one single answer because all these SAF projects or production pathway are slightly different and they have a slightly different risk profile in my view. But there is a common saying, and I think that one is the construction part and the people around it. So as Oliver said, if you have a financial investor and yourself in it, then you're probably looking for someone who is technically astute. So what I mean by that, to bring that technical capability for construction and operation of the plant. And the financial investors, most of them lacking that capability in our view as a senior lender. Second, I think that biggest risk for lenders is during the construction. So you ought to pay quite a big attention to procurement and execution of that project. And I think that's where most of it is going to be a focus for lenders. Do you have the right people? Do you have the right contracts? Do you have a right EPC contractor or contractors in place? And one thing I would like to highlight most probably is around the supply. Some of those projects, the supply contracts is quite a big issue for lenders because we simply don't have experience with it. Some of those markets are illiquid, they are not very transparent, occupied by a bunch of small companies. So feedstock supply is going to be quite a big issue for most of these projects. It's not going to be probably PTL plant, but like a biofuels, it's going to be a very big focus for most of the lenders. And then lastly, potentially, again, offtake. and then technology. Just pay attention to our technology agreements, how they are structured around for the construction as well. Yeah, I'll probably pause here.
Yeah, that makes a lot of sense, and I can feel Harriet's gaze telling me you need to talk about the UK. So I think we're going to try and transition a little bit to think about some of these investments within the kind of UK setting. And I think no better person to lay the groundwork a little bit than Susanna. What does the UK policy landscape look like? And following on a little bit from the discussion that we had in the other room, how is the UK seeing, hoping to influence investment decisions to kind of start making their way into the UK?
Yeah, so I feel we've had quite a lot of coverage of this, and the main thing the UK government is trying to do is set this sort of long-term policy direction, stability, so that you can gather the confidence from the investors that we've got on this panel. So the Jet Zero strategy came out in 2022, that set out general direction, the government's views on technologies, and some of the early indications of the support that they would offer. So I'll just quickly say on technologies, because it's not really come up yet, that although there is government interest in sort of the hydrogen fuels and the electric planes, and I'm sure there are developers here working on those. The focus is on SAF because the government is trying to advance the technology that it sees as out of the lab and the most ready to commercialize and scale, and not so much on HEFA as we've been hearing because that's already produced at scale. So we're really looking at second and third generation SAF. In terms of the support, on the demand side, there's the ETS, and then there's the mandate, which is the government's main policy to shore up demand for SAF use in the UK. It's recently come out. It should be legislated for this summer. We have to see about an election. I don't know when it is, but let's see. And then it should come into force from next year, starting at 2%, then 10% in 2030, and 22% in 2040, with reviews to see whether that's overly ambitious or ambitious enough. The problem with the SAF mandate, some would say, is that it allows imports. So there is a bit of a disjunct between supporting the demand for SAF use in the UK and supporting the production of SAF in the UK. So then we move on to the supply side support that the government's doing. There's always been grants. There's the Advanced Fuel Fund. But I think the view from industry was that wasn't enough. And that's why in quite quick progress, if you only go back not that far, you'll see that the government was just focused on the mandate and not on the revenue certainty mechanism. But that is how the revenue certainty mechanism has come about, inspired by some of the support we've seen in the power sector. There's similar mechanisms being looked at for hydrogen and for greenhouse gas removals. It's a very well-established, well-understood intervention that allows the private sector to have some certainty of returns and allow the capital that we need to move. The plan is to have that in force, because it will need legislation, which is slow, by the end of 2026. Then there's separately the plan to have 5 plants up and running by the end of 2025. So there's a bit of a circle to square there, but you can see the direction of the ambition.
Well, we have some of the people that you're trying to influence here. So I'm curious to kind of walk down the line a little bit and think about, you've all looked at investment opportunities within the UK, you've also looked at investment opportunities abroad. I'm curious what gives the UK the edge or fails to give the UK the edge when you're thinking about making some of these investments. Sort of open to anybody. I'm curious if there's an immediate response.
Maybe I'll try. So as I said, I cover also carbon capture and storage as a part of my portfolio. And I think that it's clear at the moment that only CCS projects that might actually get a non-limited debt inside will be UK projects. We have seen so many projects in the Netherlands, but also Denmark and Norway. None of them has been project finance, and I don't think that they will currently. So I think for UK, I think that the framework is there for lenders, at least, like me. But it takes a very long time. You know, the CCS system has been in making for 4 years at the very least. Hydrogen business models are shorter. It's getting shorter, but it takes very long time. But I think that UK gets things right for lenders at the very least.
Yeah, I'm curious about your experience.
I mean, it is. We don't necessarily look at SAF production plants. At least we haven't looked at. We've had some interest come our way, but we haven't necessarily explored them in depth. But I think we are a UK-focused fund with some exposure outside the UK, but largely UK-focused fund, and we'd like to believe. I mean, there is definitely a demand for SAF, and there is a demand. I mean, this is a supply gap clearly, right? Because even with, I think, the number of announced plants, I think there's only half the capacity that we need by 2020 that's been announced for production. So I think there is a big gap in the UK, and therefore creates an opportunity for new plants to come up. And secondly, I mean, at least so far, the issue was with, lack of clear political will and direction. I think that's kind of being bridged now with the mandate coming out and just more clarity coming into the ecosystem. So just purely from that perspective, I think it does make UK an interesting place for us to explore SAF production. And also, I think it just feeds into, as a country, to focus, to be more self-sufficient for our energy demands. I think it ties into all those core principles of the country per se. So I think from that perspective, it does make it an interesting place to invest.
Yeah. Well, Oliver, you spend most of your time looking abroad. I'm curious what your perspective is on the UK side of things.
So I think the UK has emerged as one of the more attractive places, and Martin, you've mentioned this as well for CCS. I think for SAF it sort of remains the same. I know the US has come out with some guidance last week, I think, under the IRA, which I have to admit I haven't read in full, and I've skimmed a summary of. But it's sort of in typical fashion seems to be fairly complicated and a few caveats and things that are not quite clear. And I think one of the things that I think I'm allowed to say this as a Brit. The UK hasn't always been very good at sort of coming out with very clear legislation, but I think that on the SAF side, actually, has been quite impressive. I think the sort of the direction and the sort of the real kind of focus on getting the SAF mandate in place, and at the same time, quite quickly working out, well, what are the gaps behind that we need to also put something in place for, I think is obviously very, very positive. Now, I think the other thing to think about is that there's the sort of the regulatory piece, but then there's the sort of actually getting stuff done piece. And that's where I think, I've certainly seen this in other areas that, of the world, you maybe don't quite have the same sort of, that kind of the real sort of drive to for people to actually go out and be entrepreneurial and take a punt on some of these things. We see that a lot in the US, of course, but other countries don't necessarily have that same kind of risk appetite more broadly. If you look at the Middle East, where I'm based. One of the biggest issues is actually on the sort of the supply side for SAF projects. They don't have large amounts of arable land that you can grow crops on. They actually don't produce that much waste because populations are relatively small. And fine, you might be able to say, well, something like PTL or e-fuels from green hydrogen, a lot of potential, but we're not seeing tons and tons of these projects, and the only large-scale one isn't something that's going to necessarily be easily replicable in the same format by lots of other developers. So I think it's a little bit of this sort of the cocktail, but obviously, I think the flip side to this question is, well, okay, if the UK is making itself attractive, what's it need to make sure that it remains attractive? And I think, making sure that that's sort of the real clear kind of vision and that's been shown so far remains. I think it's great the fact that it's mentioned earlier that there's going to be a high bar for reviewing, well, not a high bar for making any changes to the mandate, and I think that's obviously good. But I think the fact that then there's still that kind of appetite to review it and work out, well, fine, keep the mandate the same, but what else needs to come in? How do we make sure that we're addressing challenges and sort of addressing roadblocks will be really key.
Yeah. And Shambar, I understand you only just relocated to the UK, and perhaps for venture reasons more broadly than just sustainable aviation fuels. I'm curious about some of the motivations there. What made the UK a good place to be from a kind of early stage innovation perspective?
Yeah, I was going to say for SAF specifically, we've made an investment in the UK, so it's clearly we liked it. I think more broadly, there's, from a regulatory perspective, there's, as I think Oliver mentioned, there's clear direction as well, and clear sentiment, as Matangi mentioned, where we're going. So that gives at least investors like us a lot of confidence of like, okay, if we invest in this space and there's, you expect some level of support from grant-making offices or loan programs, etc. So I think that was one facet of it. I think this imbibement of entrepreneurial culture is something that's really growing. I see a lot of venture builders, venture studios, venture creation happening, which is spurring a lot of change, particularly in climate, which is very heartening. There's some fantastic IP and technology development happening at universities, which I think was previously not being commercialized, that now folks, that because they're being more entrepreneurial, are starting to say, okay, let's run with this, which is great to see across the UK. I think maybe I'll focus on a couple of things that I don't see enough of, maybe in comparison to the US. So the just sheer quantum of capital is something I think we hesitate with, because we know how capital intensive some of these projects like SAF projects are going to be. And in the US, you have something like the Loan Programs Office, which has seemingly unlimited funds that they can deploy. So something like equivalency of that is, I think, would be really, really catalytic to the process. The thing I see missing in both markets, I'd say, is we see a lot of gap in this missing middle kind of area of capital. So just post the early stage, but not yet quite growth stage. And so what do you do in this middle piece? And so that's still a challenge that I think both, that's still globally prevalent. And so that's something that I think we all need to get a fix on.
Yeah, I mean, to your point, we've sort of been directing a lot of this towards many of the SAF producers in the room. So I'm going to have one last question before we open up to the audience for any questions. So start thinking about those now. But the last piece I wanted to do was to talk a little bit directly to some of these producers. And Susanna, I want to start with you. I'm curious what advice you would have for some of these companies who are looking at either securing financing through the UK government or navigating the regulatory environment, how they might want to think about sort of dealing with the behemoth of Westminster.
Yeah, it's a tricky thing to do. Obviously, I'm not in a position to advise any developers myself, but if I put myself in the position of a minister and think I imagine what they would ask, it's that ministers have multiple priorities, and we've heard about some of them here today already. Obviously, they would love a nice new shiny SAF plant and a ribbon to cut, that's great. But some of those priorities are motivated by security of supply, as you were saying. That's been a huge issue and challenge, and we've seen motivations for that support big investments in other sectors like the Jaguar Land Rover Gigafactory. Then there's the questions about jobs, leveling up. A lot of these industries are in rural areas, and you can see that industrial strategy piece coming through. A lot of the policies that you see or the developments that you see succeeding through Westminster tend to be win-win-wins. You have to find wins on the multiple different facets of what a minister is preoccupied with. And then there's the old age saying in Westminster that if you're explaining, you're losing. You need to find a way of conveying your wins in a very simple way that is going to be able to cut through a lot of the noise. And we've seen precedents where you can make these cases and they succeed, like with the Jaguar Land Rover, or like with Hinckley, where that's got a very expensive CFD and has arguments for security of supply and industrial strategy and all those things. And similarly, where they have not succeeded, like the tidal lagoons, which had a great economies of scale argument to it as well. I think there is a real question that we've sort of touched on about when you're not a pilot plant and you're not ready to scale through the CFD, the missing middle at the GFI, we called it the Valley of Death. How do you prove that you are beyond technology risk, but you've also can develop that technology at scale? It's those kinds of concerns that ministers don't want to put consumers on the hook for, to be paying over the odds for that kind of risk quantification. So how do you make sure you've ticked all of those boxes and you can present that win-win-win?
And Martin, maybe we'll go to you next. You've seen a lot of these opportunities come across your desk. And I imagine you've hit some frustrations of, oh my gosh, people keep making the same mistakes, or other kind of pitfalls that people run into. I'm curious if you have any advice or things you want to warn people of who are thinking about making a pitch to you and trying to secure some debt financing. Keep the expletives to the minimum, I think, we're in a government setting.
Yeah, so I think lots of SAF projects have made great progress technically. I think that we've seen really well-developed technically projects with EPC contractors and technology providers, which we didn't see maybe a year ago across EMEA region. I think commercially, I think the concept needs to be that leaves very little risk or margin risk inside the SPV if it's a non-recourse financing or limited recourse. And I think so you need to pay attention the alignment of the feedstock, plant performance, and offtake contract. And I think that's where most of these SAF plants are missing the piece today. I think technically, you've done a great job over the last year, most of you, yeah, in the UK and potentially in Europe as well. Yeah.
We'll go to you next on the advice for producers.
Yeah, so I think one of the things that I always say to people is, particularly when you're looking at banks, come to banks early. The worst thing possible is to basically not speak to a single bank until you think you've got a structure and you want a term sheet signed, because it's never going to happen. I can see Noman straight in front of me. I mean, we've been speaking I've been speaking to Alphanar in 2 different banks now, which says just how long we've been speaking to them. And I think the real value of having that early conversation is that you can then build in sort of feedback and really understand how do you make sure that you're creating something that works. From Barclays' point of view, we can sit as a senior lender. We can also help to bring in equity as well. And the thing I think people need to remember is that really to make these projects work, everyone needs to kind of win. So if you are, as the developer, you're too aggressive and trying to squeeze your banks too much, particularly for your first project, that's just going to put people off. So you need to have a little bit of sort of give and take. You need to show where you're being flexible. As banks, we also need to make sure we're not trying to claw too much for ourselves, trying to sort of say, well, we've got find a way to sort of mitigate the financial risk from our point of view. And I think really having that early conversation, taking the time to build the relationship, to show the progress that you're making, to get feedback in a constructive manner, I think is really crucial.
Let me pass down to Pathangi. Any other advice for maybe moving a little bit up the chain here a little bit, but thinking about when people are making a pitch to you, some of the best practices or maybe some of the worst practices that you've seen through that experience?
I mean, we see all sorts of pitches, right? I think one consistent theme across early stage businesses is to just build very unrealistic financial projections and financial models. I think that's really the thing that we grapple with, because I agree, because it's early stage, there's very little to go by, so all of it is just up in the air numbers, and it's all, I mean, we can just make it up on the way. But I think it needs to be slightly grounded in reality and kind of should withstand the stress test that you would put it under. So I think that's very important to, yes, have an ambitious plan, but also grounded in reality. I think that's something we continuously kind of grapple with early stage pitches that come our way. I think the other one is also because some of these technologies are a bit novel and new. I think either if they have a prototype site, for them to actually, like Oliver said, come to us slightly early, have those early conversations, take us through the journey a little bit so that we can understand understand the technology a little bit better, and also just kind of see the pitfalls, the challenges that they face through it. Or if there's a prototype elsewhere, somewhere else, someone has kind of cracked that technology, for them to actually probably explain that, and probably for us to go visit it also. Just kind of give us a little bit more comfort that we're not, it's not completely untested and that's completely kind of, completely new. I think just some more comfort on reliability of technology, I think, is another bit that I would think people should help demonstrate when they come to early stage investors.
Yeah. And maybe finish up with Sean more, thinking about, Clean Energy Ventures must look at hundreds, if not thousands, of these pitches on a pretty regular basis. I imagine there's probably more than one company here who's thinking about submitting their deck to you. I'm curious what advice you'd have for somebody to try and set themselves apart or set themselves up for success when raising from you or any other of the kind of venture-oriented firms in the UK.
Yeah, so just to set context, I think I typically, simply describe the stage we invest in is, when there are 2 people and a dog in the lab and the dog's doing a third of the work. That's how early these companies are. But one thing that I think is fundamental to all companies that we surprisingly rarely see is the thoughts, like just the simple concepts of putting milestones on a timeline, risk reduction, and value creation. So how do you, what is your multi-generational plan? You're not going to solve everything overnight. You're not going to solve everything even in the first generation. How do you think about what is highest priority, what gets you to lowest risk for follow-on capital, for other folks to take you seriously, and then how do you create value from that going forward? So that is, I think, the core part, and then also team around that. I know it's cheesy, but you have to think about what are the components as you're going through that milestone, those sets of milestones. Do you have the right skill sets? You are going to be an early stage company. We understand you will not have all the skill sets. That's not how company building works. But how have you thought about who you need to bring in, what stage, and what's appropriate, and being realistic around how much financing you need to do that?
Great. Well, thank you all very much. For the last 10, 15 minutes, we're going to open up to questions from the audience. I think we've got one immediately. So there's someone in the middle there. I'm sure if you have a spare mic. Sorry. Someone in the middle, the red shirt, yeah.
Thanks very much for the discussion. My name is Sarah from Fly Green Alliance. This is a question for Oliver. You mentioned before about, hang on, I wrote it down, I briefly might forget. Actually, yeah, you were mentioning techniques for mitigating risks. Would you be able to share some from a banking side? And then also you mentioned some flexibility from the SAF producers. Can you let us or share some of the flexibilities you would be looking for?
So, look, I think there's no set list of these things, really. It's all done on a very much project-by-project basis. And I think Martin's referred to some of these things as well. But really, when we're looking at it from the risk point of view, we'll basically, if you're looking at it as a bank, you're going to break down the project into all of its different component parts. You're going to look at what technology is going to be used, where the feedstock is going to be coming from, who you're going to be supplying to, which contractors you're going to be used, where you are with your sort of, the land that you're going to do this project on, where you are with the permits, what regulatory environment are you in, what track record do you have as a company, if any, in raising capital from other financial institutions, whether that's other banks, whether that's other investors. Who are the different equity investors that you've got? We'll look at, particularly for the earlier stage thing, we'll look at who's an investor in the top co as well, not just at the project company. We'll look at, who we can sort of get information from. So, really it's about, thinking about all of these different elements. How are you able to mitigate as much risk as possible? You cannot ever mitigate everything. It's a simple fact. There are always going to be risks. So then it's about understanding, well, how are you going to go about things? Martin talked about the procurement strategy. What is your procurement strategy? Do you have a backup? If suddenly you can't get things through, or things are going to be delayed significantly because shipping traffic can't go through the Red Sea, what is that going to do to your project? What is that going to cause to delays? Do you have a separate strategy? Are you purchasing all of your components from one country? What's the geopolitical sort of situation between that country and the country that you're doing your project? Is there a risk that suddenly you can't get trade? So there's a very long list of things, and as a result, there's no sort of single answer about it. But really, those projects that succeed, they're the ones that have really thought about these things and that have worked out, in their particular context, how are we going to be able to sort of execute this as best as possible.
Any questions? Right at the front. Sorry, I realize I've brought you to the complete wrong corner of that.
Hi, it's Matt Finch. I'm the UK Policy Manager at Transport and Environment, and I sit slightly outside the SAF world, but interested observer. And my observation is that on the one hand, we have airlines who've been crying for ages that they just can't get hold of enough SAF. On the other side, we have the SAF producers going, well, we're not investable enough. There's too much risk. What's the disconnect? Which airlines are not putting off-take agreements in place? You know, there is clearly a problem there. How do you solve that?
Yeah, I mean, Martin, you might have a perspective on thinking about where the role of some of these off-take contracts in being able to reach FID for plants.
So first of all, I haven't seen many off-take contracts. I've seen lots of MOUs and LOIs. I've seen very few, let's say, binding heads of terms or fully termed agreements in the SAF world. I think that I wouldn't point the finger on airlines. I don't think it's their business to really make these investments. I don't think they've been ever set up that way. I would potentially ask the traditional suppliers of the fuel. I've seen very few of them around in a sector. And then they also control the access route, I would say, to the airport. So I would really ask what the fuel suppliers are doing. I know that their ventures arms are very active. I haven't seen the real investment and production arms are stepping in. Just for everyone to know, I spent almost 12 years in a BP, and so I know what I'm talking about. So I would almost ask, where are these fuel suppliers in the UK, for example?
Yeah, I mean, to your point, there's an interesting point there that airlines are traditionally used to buying fuel basically in the moment, and thinking about a sort of 15-year off-take contract is not something that they're necessarily kitted to do. Let's see if you comment on that as well.
Hi, Matt. I think this disconnect is an important aspect which has helped drive the motivation for the revenue certainty mechanism. We did some modelling at the Green Finance Institute, all based on publicly available information, so heavily caveated and full of assumptions, which said that if you did create a CFD, or a guaranteed strike price, as the DFT like to call it, because the price of SAF is so high, and because you pay back above the strike price if it is so, it could result over, say, 15-year term of a contract in a net positive to the scheme undertaker, say the government. And I think that was one of the main things that allowed it to get to the consultation stage we're at. So there are some advantages in the disconnect, and that's where some of these policies could help bridge it. On the offtake question, you're right that there aren't a lot in the market, and it would almost be sort of a holy grail. And to the earlier question of balancing different risks, I think there are some levers that you can pull, and if you have rock-solid certainties in some aspects, you can accept a little bit more risk in some of your other areas. And if you had a really strong offtake, then that could help. And that's something that we may need to address this missing middle, this valley of death between the companies that are trying to scale to pilot stage now, and then would be at a scale to move into a revenue certainty mechanism. You may need some kind of direct offtake support between now and 2026 to help those plants get off the ground, and that's something that the industry, as I understand it, is looking at.
Great. Any other questions? Right here at the front. Sorry. Yeah.
Thank you to the panel. James Fibbins of Bechtel. I guess it's drilling into the risk a little bit further. Kind of two questions, really. Does the panel have a view on risks of UK construction, given the potential volumes of work that are coming up, in terms of availability of craft labour and so on? And secondly, do they have views on the sort of ask of the EPC contracting world in terms of skin in the game on fixed pricing, wrapping of the technology, etc.? Because that's a challenging area for a lot of contractors, or it should be if they're doing their job properly. Thank you.
Any thoughts on the EPC environment?
So I don't have a lot of experience with this, but just given on the limited exposure, a lot of our companies engage with the likes of Fluor and etc. I think they see it, particularly some of the more, how do I say this, nimble ones, as an area of great opportunity. because there's going to be a lot of disruption in a number of different markets that the EPC contractors can really benefit from. Whether they end up becoming acquirers of certain types of engineering innovations or not is a whole other question. But their involvement definitely adds a layer of credibility to an early stage startup, which because say I don't know, an Aramco or someone uses a certain type of EPC, using those same folks drastically speeds up the deployment process and acceptability of plants at site. So it's I think it's fundamental. It's an actual area that not a lot of startups think about. A lot of folks believe they can do it solo, but that it just seems like a missed opportunity to not engage the EPCs.
Yeah, and please.
Can I maybe comment? So I think that we as the lenders are struggling with the amount of work now asked by the UK government in general. Now we know that there are 2 CCS systems coming potentially towards FID at a similar time, including CO2 sources, at least some of them, which I think is going to put strain in addition to potentially having the SAF plants. And we're going to be in ongoing stress, probably in the UK. Regarding EPC contractors, whether we have a preference for the lump sum turnkey contract or EPCM and so on, I think that's going to be always the question. And I think it's going to come down to who are the sponsors. Can they sponsors, consortium manage EPCM contract and maybe pick the right EPC contractors for the right agreements, EPC agreements? That is being debated. And we've seen usually the startups or like companies that have no revenue or maybe potentially weak financially to go or move towards the lump sum turnkey. We see some contractors doing this. And then more like a financially astute consortiums are looking at EPCM. I think that for banks, as Oliver said, we will scrutinize, we will assess, we will try to break it apart, but I don't think there is an answer, a single answer for it. I think it can be both. It depends what consortium you build around it.
And I also think that's a good reminder for the producers in the room, to Oliver's point earlier about working with banks, you talk to them early and often. And I think the same principle applies in many ways to EPCs. I think there's an assumption, when we look at projects across SAF and a bunch of other spaces, it's somewhat obvious, but the success rate of these projects goes up pretty significantly when they start to secure EPC contracts, even if they do so pretty far in advance of actually constructing the plant. And there's sometimes an assumption, particularly with more technically minded founders, that, well, we'll just hire somebody to build it when we get to that point. But as anyone who's worked with an EPC can tell you, it's never quite that simple. So it's a good reminder to the importance of having those conversations and having strong contracts there. Okay. Any other questions? Let's see one on the far side.
Hi, Chris Sim, Commercial Director at Zero Petroleum. A question to Oliver and Martin. So could you maybe give your view on the ability or otherwise in terms of the revenue certainty mechanism's ability to unlock conventional debt finance, or whether complementary measures might be needed to address technology risk, for example?
I think it's, Chris, I think that's a very good question. Why? I think that a CFD type mechanism, what we have seen in the UK, do not understand a first of a kind risk, in my view, unless you go to a carbon capture and storage, where government backs certain risk, including cost overruns and potentially availability restoration. I think we don't see it in a hydrogen business models, maybe as much as we would like to. So I think that's something that people need to address once they develop these models. I think it's the first of a kind nature of the plant. And I think first of a kind configurations will remain with us for maybe a decade, given the pathways and number of pathways we're talking about.
Well, I think I'd agree, which is a good thing. I think once we move beyond first of a kind, then I think it does look like the current proposals being discussed, at least if you look at sort of the guaranteed strike price, as it's being called, and the buy of last resort, would have the potential to then sort of secure more. I think one of the things that I guess we're talking a lot about sort of the kind of the supply side bit and sort of what's the risk of someone not buying it. I think the other thing to think about, and maybe this is an interesting bit, and to Matt's question earlier, there's also the risks of sort of the airlines, if they're purchasing SAF and they're saying, right, well, we're going to lock ourselves into these contracts. What happens if those projects just stop working? What happens if they run out of fuel supply and all the rest of it? Now, that's a risk that you take, right? I don't think airlines are really prepared for that risk. I don't think they have the ability to manage that properly because they're used to basically buying jet fuel. And you can get jet fuel from pretty much anywhere. It's fairly homogeneous, and it's very widely traded. So I think there's an element that we also need to think about, which is that sort of, what could be done to help generate that confidence for the airlines to actually go and make those offtakes in the first place.
Yeah.
Thank you. Hi, Chris. I had two additional things to say. One on the airline point, which I think is really important. Airlines are going to have to shift the way they operate, and they are limited in how they can do so by their own regulation. There is very strict concern about competition amongst airlines, with good reason, and that limits their ability to build consortiums and to support offtake and to act in a bit more of an innovative way in this market. So as they shift to this new role, that might be something to be looked at. And on your bigger question about debt support for especially first-of-a-kind projects, it's not an active suggestion, but just an observation that I believe the UK Infrastructure Bank has something like 12 billion of guarantee pot, which is yet to be spent. And this kind of infrastructure is probably the exact kind of thing that they are looking at. It's just, if anyone from them is here, it's just an idea.
I think a note of excitement and optimism is a good one to end on, especially since we're keeping you from lunch. So please join me in thanking a wonderful panel and really great discussion. We appreciate it. So next up, everyone is free to head out for lunch now. Yeah, brilliant. Thank you very much.
Airlines and aircraft makers are desperately searching to reduce their climate impacts. CO2 emissions amount to about 2% of the global total and 7% in the UK, and are increasing. But there are other impacts, such as the damaging contrails. Back in 2011, I was granted a patent for a novel way to generate power and hydrogen from hydrocarbons. Highly efficient fuel cells and electrolyzers make this possible. Using this patented process as a front end to a more conventional gas to liquids process, we can turn all sorts of worthless waste into high-value fuel, help clean up the environment, and solve the problems of disposal in one fell swoop.
Making sustainable aviation fuel in sufficient quantities is a massive chemical engineering challenge. We've already started building our bench scale system, which will just prove the concept. So we'll take some waste, which is our feedstock, and we'll create some fuel to demonstrate that the process actually works. The key step is then our demonstration system, which will be a 5,000 ton per year plant, and that will be a very faithful reproduction of the larger scale plant that we're going to scale up to. Then we're going to scale up to our 30,000 ton per year commercial plant, where we're making fuel, selling the fuel and making money for the business. Jet fuel is a tightly regulated product. In our case, we have to meet those requirements, but we also have to meet the requirements that it's sustainably produced.
Reducing global temperatures and protecting our planet is a key generational challenge. Our mission at Aviox is to deliver the world's most technologically advanced refinery, making sustainable aviation fuel. We believe that the plant will be highly profitable due to the very low cost of the waste materials as input material. We need the resolve and the capital to make a radical shift within our economy to make it modern, circular, and sustainable. This is a once-in-a-lifetime opportunity to join a new wave of clean tech companies developing clean, green, and sustainable aviation fuel, and it's a privilege to be part of it.
Good afternoon, everyone. Thank you for making the effort to join us on this sunny afternoon despite the challenges posed by the train strikes. Your participation is greatly appreciated. I am Daniel Perdomo, Managing Director at Positive Impact MPG, where I provide advisory support on insurance and clean technologies. My previous job experience includes roles in insurance at Lloyd's and working on clean technologies at the Carbon Trust for over 15 years. Today, our panel is set to delve into a crucial topic: how insurance can facilitate the adoption of sustainable aviation fuels. We will focus on 4 key areas, each of which plays a pivotal role in this context: understanding the risks associated with SAF, the challenges insurers encounter in providing coverage, opportunities to address barriers to its uptake, and avenues for innovation in insurance products. Before we delve into our discussion, allow me to introduce our esteemed panelists. Each brings a wealth of knowledge and expertise to the table, ensuring a high quality and insightful discussion. First, next to me, we have Charlie Dubek, who brings over 7 years of experience in the aerospace insurance industry. Within WTW Global Aviation Space and Division, Charlie is a passionate ESG lead and an associate director in the aerospace line of business. Charlie holds an advanced diploma in insurance from the Chartered Insurance Institute and a certificate in business sustainability management from the University of Cambridge. As an ESG lead, Charlie is dedicated to developing and implementing strategies aligned with WTW's vision. She collaborates with stakeholders to identify ESG risks and opportunities, creating innovative solutions for clients. As Associate Director and Broker, Charlie manages complex insurance programs and provides exceptional client service. She also contributes to the airport risk community, sharing expertise to mitigate industry risks. Charlie's experience in aviation and ESG will offer valuable insights into our discussion today. Joining us next is Rob Bates. Rob has over 11 years of experience across various claims, underwriting, broking, and risk advisory roles, bringing a holistic perspective that unlocks the best possible terms to clients. Rob started his career in claims, managing offshore wind losses for the world's largest renewable energy insurer, G-Cube Underwriting Limited, where he handled nearly every major offshore wind claim from 2013 to 2016. After claims, Rob moved to underwriting, eventually becoming head of offshore wind underwriting at G-Cube, where he led the insurance of some of the world's first floating wind projects and offshore wind fixed projects. Rob has been involved in more than 100 renewable energy projects across North America, Europe, Africa, Asia, and Australasia. Rob holds a master's degree in history and international politics, specializing in energy policy and decarbonization. Rob's experience in emerging clean technologies, including offshore wind, will provide a unique perspective on the challenges and opportunities associated with insuring SAF. Completing our panel, we have Andy Rumens. Andy has been a senior underwriter at LRA London since October 2023. In his role, Andy is responsible for underwriting general aviation risks in the LRA London portfolio. Andy has been in the aerospace insurance industry for 10 years. Before joining LRA London, he worked for AXA XL, where his last position was General Aviation Underwriter. He's also heavily involved with ESG and innovation initiatives, serving as co-chairperson of the LRA ESG Working Group and an active member of the Innovation Group. Andy also participates in aviation insurance industry organizations, including the International Underwriting Association Aviation Group. Andy's background in SAF and innovation will contribute to our exploration of innovative insurance solutions to promote the uptake of SAF. Without further delay, let's begin our discussion by addressing the panel's questions. Charlie, Rob, and Andy, can we start by introducing your organization and explaining what insurance solutions your company offers across the SAF value chain?
As Daniel mentioned, I'm from WTW, formerly known as Willis Towers Watson, might be a more familiar name to some of you in the room. WTW is a global advisory broking solutions firm with roots dating back to 1828. We've taken climate and ESG very seriously since 2014, actually, and we were the first broker in insurance to sort of set up an internal climate hub focusing on delivering solutions for our clients. We have a huge depth in the area, Over 100 members of the Climate Hub sit across the globe, and it's an award-winning team. Just to mention some of the accolades, we were attributed to founding the Insurance Development Forum with the UN and World Bank. We co-founded the Coalition for Resilient Investment. We're proud of our Willis Research Network, which is a non-profit within WTW that works with academics to provide research to push forward the climate agenda. And in terms of the SAF products that we can provide, we are obviously one of the largest insurance broking houses globally. So we specialize in risk management and risk transfer across the SAF supply chain, from downstream SAF production to aviation refueling labs. And also something we've seen a more recent uptick in is environmental liability policies that looks after sort of incidental pollution or biodiversity disruption that could come from the production of SAF. We're also continually looking at innovative products. We've partnered recently with Kita, who are providing insurance for the non-delivery of carbon credits, and we're exploring viability of how we can work with SAF as a credit as well.
I've got one. Hi, I'm Rob Bates. I'm a partner with NARDAC. We are an energy and infrastructure broker. So we are the intermediary between the developer and the insurance market. It's my job to save the client time and money on insurance. And we've been focusing on renewable energy. We've also been looking at things like green hydrogen, carbon capture and storage, and those sorts of clients are looking at SAF production. So it's SAF production that we focus on rather than usage and transport. So far, we've provided risk consulting services, so identifying what the risks are associated with SAF production, and then also starting to structure some insurance policies for some of our early clients. There's not been a huge number of projects yet, but the early projects are coming. So our role at this point is to help design the insurance product, help speak to lenders to help unlock the finance that will get these things built.
Hi there, and my name is Andy Rummans, and I'm a senior underwriter at La Réunion Ariane, or LRA for brevity. So LRA is an aviation underwriting agency with 70 years of history in the aviation market, writing across the core aviation classes of business, being airline, general aviation, aerospace, and space. Obviously, with 70 years of history, we're looking ahead to the future, and this is why this topic is really key for us as a player in the market to understand the needs of our clients and the stakeholders in the industry as to what insurance solutions we need to be able to offer in the future to maintain our relevance. One of the unique features of LRA is, as we are a monoline underwriting agency, our only focus is on aviation risks. So the prosperity of the aviation industry is fundamental to our success going forward. So it puts us in a unique position when it comes to speaking with clients and stakeholders, because ultimately, to maintain our success in the future, we need there to be a successful aviation industry. So I think that's definitely something from an LRA perspective which differentiates us in the market.
Thanks, Andy. My first question is to Charlie. What challenges arise during the production of SAF, and how do these risks differ from those associated with conventional fossil fuel production?
So I just want to caveat that my area of expertise prior to sort of joining the ESG side of, and leading that for WTW Global Aviation is in the aviation liability side. So Rob, feel free to jump in on the production question if you have any particular comments. So in 2023, SAF production doubled globally, but it did fall below expectations due to delays in construction, permits, and feedstock constraints, and investment as well that Rob touched on briefly. But one of the main challenges was due to the production and the challenges that the SAF production has versus conventional fuel. Obviously, I think everyone in the room that's here today will know that the main challenge is feedstock availability. SAF can be made from a variety of sources, waste oils, agricultural residue, dedicated energy crops, but ensuring a consistent supply at scale is difficult. And obviously there's competition with food supply and also land use concerns. One of the things that sort of from an, aviation consideration is, on one hand, you have the ESG sort of metrics that ask you to look at biodiversity, etc. But there's the downside of biodiversity as well, and I appreciate that this isn't always clear. But for example, depending on where these biodiversities are being increased, they could cause additional risks in terms of bird migration patterns, which could affect aircraft and bird strikes as well. So this is kind of one of the risks, I guess you could say, is a bit more unusual. I guess the more traditional risks, if you like, from the production side is around the technology development and the efficient and scalable technology that's needed. Again, I did some research before I came here. This isn't sort of my area of expertise, but noting that the hydro progressing is needed high pressure and high temperature reactions, and this can lead to equipment corrosion and failure and safety hazards if not managed correctly. As well as contamination in feedstocks. We were talking about this earlier. SAF is a drop-in fuel, so contamination risk is fairly low, but it's still something that insurers need to be aware of and need to fully understand. And finally, certification and regulation. There are strict regulations and safety requirements that are needed, and I think the kind of key point here is that insurers need to rely on the likes of ICAO, IATA, etc., to impose these safety standards so that they can be reassured that the SAF that's used in aircraft are safe to use, and that their clients are, able to have comfort in the fact, and they have comfort in the fact that the SAF available, is credible and certified effectively.
Thanks, Charlie. Rob, is the market for insurance coverage for SAF adequate? Are the premiums prohibitively high, which might impede its widespread adoption?
So insurance is available to cover the main sort of property damage, loss of revenue, legal liability insurance that most of our clients are seeking. However, it is expensive. And the other key issue is a lack of coverage for defects. So people are talking about technology risk insurance quite a lot at the moment. Probably the biggest exposure of the traditional list that Charlotte just mentioned would be property damage following a defect. Now, it's very difficult to get insurers on board with the idea of insuring full defects cover for these quote-unquote new technologies. So a big part of my job is trying to kind of demystify the technology. Someone pointed out to me earlier that the Fischer-Tropsch mechanism or process is actually quite old. We've been doing it for over 80 years. So explaining that to an underwriter and saying, okay, well, it's actually quite known technology, albeit combined in a fairly new way, that helps the conversation with insurers. I wouldn't say it's prohibitively expensive, but it is much more expensive than insuring other renewable energy technology types or even green hydrogen. It is 5 times more expensive to insure a SAF production facility than it would be to insure a solar PV project. It's much, much more expensive. So there's a lot of work to be done. More projects need to come online. The fact that there's only a handful at the moment is a big problem because insurers have to price in a lack of volume. But in time, I think those prices will start to come down as underwriters become more familiar with the technology and brokers like me, explain the risk properly.
Thanks, Rob. Andy, based on Rob's answer, how can collaborative initiatives between insurers, airlines, and SAF stakeholders accelerate the adoption of SAF insurance?
So I think the key word there is collaboration. And I think it's very easy for underwriters and insurers to get certain ideas in their mind when a risk is produced to them by a broker. But if that underwriter or the insurance company doesn't understand the full life cycle of the risk as such, and that comes from the production, the supply chain, the underwriter will only be taking a very narrow view on the topic. So I think the key thing, and it's almost not an appeal, but a recommendation to those of you in the life cycle around the room is to look to engage in constructive conversations with your insurance broker and ultimately your insurers about what you are looking to achieve. Because then we move away from a situation where underwriters look at a risk, and the reality is for underwriters who generally base underwriting decisions and pricing decisions on data, when a risk is new, the default is to be more expensive. However, if there's a conversation throughout the life cycle, it's much easier to have some perceptive conversations, and that makes Rob's job and Charlie's job a lot easier when they come in to speak with underwriters. To give you an example, the electric aircraft, when they first rolled out, the Pipistrel Velis Electro, the hull rate that you were seeing on that was probably around 15%. A similar Cessna 172 at a conventional with that similar value, you'd probably be looking at 1.5% to 2% hull rates. So that new startup cost for new technology is there. And the only way to mitigate that is to enter into the conversations and get the insurance industry on board as soon as possible from the outset.
Thanks, Andy. And Charlie, are you aware of industry-wide efforts to standardize data collection and reporting for SAF?
So we were discussing this before we came on. The insurance industry collects a wealth of data, claims data, passenger data, movement data. There's a huge amount of data collection that goes on. What we're perhaps not so good at is using this data. So, you know, in an ideal world, we would have SAF standards and data collection would be kind of standard across the industry. It's still an emerging technology. It's still a very small percentage of the overall amount that we see our clients using compared to conventional fuel. So at the moment, don't get me wrong, insurers will ask the question, you know, what percentage of SAF do you currently utilize or expect to utilize? What are your targets? But how that data is actually used is very unclear at the moment, I guess would be from, and I can say that from a broker's standpoint, and you might interject as an insurer and have a differing opinion on that. But I think the key thing, and this again comes back to Andy's point, is that the communication between clients and their insurers from the outset should be really clear, so that there can be a sort of collaborative effort in terms of making sure that your policies are fit for purpose to cover your future ambitions, but also that you know, that there's a reflection in your commitment to the transition as well, and we hope to see that sort of moving the dial from the insurance standpoint, you know, in the near future. As I said, the insurance industry is sort of at a critical junction now. We are seeing our clients ask increasingly around, you know, what are insurers doing with this data? And I think there needs to be sort of a bit more of a commitment from insurers to sort of say, you know, we're collecting it and this is what we're doing with it. But we're not quite at that mature stage yet.
Thanks, Charlie. And talking about data, Rob, what data gaps exist in assessing SAF risks, and how can insurers access reliable data on SAF performance, incidents, and claims?
Well, I think it's less a case of there are gaps than there are sort of yawning chasms of no data anywhere. It's quite difficult to put stuff together in a like a submission for underwriters to have a look at. And I think this is where the collaboration across different sectors and across insurance, finance, the SAF sector itself could really help. And then the other thing we need to do really is start setting some standards. That was a key reason for the growth of offshore wind and floating offshore wind, where we had underwriting and engineering guidelines from the likes of DNV, and that helped us explain what good looks like. Once we can do that, underwriters have a much better idea of what good looks like, and then they can price in less of a technology risk to begin with.
Yeah, thanks, Rob. And my last question for Andy. Considering the growth of SAF adoption, what innovative insurance products can support its scalability in the aviation sector?
So I think the first point to address, maybe within the context of the aviation insurance market, of what challenges does the scale-up of sustainable aviation fuel provide there? And I think the answer in the aviation market is very little, because it's a drop-in. So the conventional exposures that we face in the aviation insurance market don't fundamentally change. Where the risk probably impacts it the most is where you have refuelers liability insurance. But then again, SAF is designed as a drop-in, so you're not going to have a similar issue with contamination as you would if it was another substance contaminating the fuel. So I think that's the first point to address there. And then secondly, I think it's having a look over the horizon and what types of risk and types of exposures do we see emerging in the future. So one of the key areas which I think will be a topic to discuss is in the non-delivery of SAF, particularly when it starts to become mandated in legislation, and what exposure that creates. Are SAF suppliers going to be sued by airlines for not providing the levels of SAF required by law? And what solutions could potentially be provided? I know that across the market, a lot of work has been done into looking at alternative indemnity solutions. So would insurers be able to provide or offer a carbon removal or offset to indemnify uninsured if the SAF that they were looking to procure isn't delivered, in order to keep the impact on the emissions the same? So those are the kind of things which are being explored at the moment. But again, it's very easy, going back to my last answer, for us to sit in the square mile in the City of London and come up with different solutions where we feel that an insurance coverage may or may not work for SAF. The reality is it could be completely unviable from an industry perspective. So it's good to, coming back to the collaboration, hearing about what you perceive the risks in your business to be, and where you would be looking for the insurance industry to support you in delivering the scalability.
Thanks, Andy. Very interesting to hear how the needs of clients, in this case, the aviation industry, asking for claims paid in carbon units, start creating carbon units as a commodity. And this, of course, has huge implications on the topics of climate change and new instruments and mechanisms to get to net zero. Good. So during the next 15 minutes, we will have a Q&A session with the panelists. If you have a question, please raise your hand and state your name and organization.
Hi, I'm John Petchton, Untitled Ventures. We've been conducting a survey funded by UKRI on debt financing first-of-a-kind projects, specifically hydrogen, but including potentially SAF. One of the findings is that actually there is a range of products, insurance products, for technology risk insurance provided by the likes of Munich Re, AXA, Ariel Green. So, for example, Munich Re can provide a warranty for an electrolyzer producer that uprates it from, say, BBB to AA, which then makes your project bankable. One of the exhibitors here, their plant to make the first MSW to SAF in the world only got financed because an insurance company provided technology risk insurance. Very few people are aware of this in the UK. In the US, there have been a few $1 billion of technology risk insurance provided so far. In the UK, zero. Can I please ask the panel, what do you know about technology risk insurance, and how do you see it being applied in the UK SAF industry? Thank you.
So it's been quite widely deployed in the solar sector. I know Ariel Green have been really successful in deploying that technology, that product. And it's enabled them to give really, really long warranties, like 20-year warranties for solar panels. And that got the conventional insurance market, who are taking on the risk of weather damage or electrical breakdown, those sorts of risks, it's enabled them to get much more comfortable with the projects, knowing that there's a very long warranty that's backstopping the technology risk. And that means defects, and defects can often be the largest types of claims that affect projects. So it's a major win if a client can secure that kind of technology risk insurance product. They're quite well understood for other bits of the market that we serve, like renewable energy. But for SAFs and hydrogen, it's very, very new. So yeah, you're quite right to point it out and to raise the profile of this product line.
Would you like to complement, Andy?
Yeah. So I think, yes, that coverage does exist. I know in my former life, it was known as a performance guarantee insurance. It fell outside of the conventional London market suite of products, being your property and casualty. It actually sits within some alternative risk transfer teams working on different solutions, kind of outside the box entrepreneurial underwriting solutions. So yeah, those kind of products are available. From what I understand, they're not the cheapest. They do require quite a lot of upfront premium to be paid, but then they are structured over a substantial period of time. So it is a way that the insurance industry can support that and facilitate that investment happening, but obviously the startup cost for the product is substantially higher, and they are underwritten very carefully on a case-by-case bespoke basis. So that level of bespoke coverage also obviously has an implication on the cost, because it's not a case of looking at the law of large numbers and how insurance conventionally works. You're having to generate bespoke solutions for individual risks. But I think a lot of it comes down to appetite in the market as well. I think the market as a whole has been reasonably hard for the past 3 or 4 years. And I think as the market maybe softens, I think people's appetite towards this kind of product may change for the better for buyers of insurance.
Very interesting. And you were saying that this type of bespoke solutions can be expensive. Do you think that here perhaps there is an opportunity for collaboration, creating a type of risk pool solutions where perhaps the government can take a first loss and then underwriters in that way can help, like with the first insurance, and try to get data, and then with the time lower the price of this type of solution?
Absolutely, Daniel. And you have to forgive me because I'm not an expert on the subject, but I think where you look at examples of people working together on insurance, whether that's government and the market, there are a lot of solutions in place already, whether you look at pool re and dealing with the floods. So there are precedents for where insurance and the government work together. So yes, absolutely, that collaboration is crucial. And obviously with the Jet Zero strategy, the collaboration across all stakeholders should be extending to insurers and policymakers, as well as the stakeholders within the industry.
Please.
Hi, I'm Barry Moss from Avocet. A question to Andrew. What can be done in terms of the insurer's side to promote the use of sustainable fuels? A point in question, I guess, is on the shipping side. You have the Poseidon principles for finance and also the Poseidon principles for insurance. The Pegasus principles or guidelines for aviation were just launched last month, but there is yet Pegasus guidelines for insurance, if it's ever going to happen. Is the International Underwriters Association looking at some form of consistent approach in terms of underwriting, in terms of either discounting premiums for SAF, or when it comes to Scope 3 liability of all insurers who are now going to have to report Scope 3? Is there any form of consistency coming through the market as you see in terms of approach?
At this stage, no. I think bringing up IUMI and the Poseidon Principles is a really interesting topic, because I think the marine industry definitely are ahead of the aviation industry in terms of how they are collaborating. I think the implementation of the ETS and the regulatory regime from 1/1/24 accelerated those conversations. I'd expect over the next 18 months, 2 years, those conversations across the aviation market and the stakeholders there will be accelerated as well. In terms of what can insurers do to encourage our clients to scale up the use of SAF, the encouraging thing is when I speak to clients and raise the topic, they're already voluntarily offering SAF solutions to their client base. So in the general aviation market, a lot of the clients we deal with are mission specific. They're going in and performing contracts on behalf of large commercial operations, and they have got initiatives that allow them to invest in SAF and use a particular blend of SAF on particular flights, and they're already voluntarily asking their clients to buy into those schemes, and the uptake is reasonably high. In terms of discounted premiums, I'm not so sure on that one. As I mentioned before, I don't think fundamentally the risk profile changes. You can take that as insurers not being particularly generous. However, when I think you take into account the new technology cost you see with electric aircraft and the example that I gave before, I think that should be a positive message to buyers of insurance, that underwriters aren't imposing additional premiums because SAF is being used instead of conventional fuels, and that's very different to the other mechanisms that we'll likely see on the decarbonisation journey, whether it's electric or hydrogen power.
Thank you. I'm monitoring the online chat, so I'll be pretending to be someone else just for a moment. So my name is Nick Churchwood, and I'm a partner at UK law firm Burgess Salmon. And the question from Nick is, do the panel see any SAF-specific risks in insuring a SAF production plant compared to when you would look at insurance for, say, an energy or waste-to-energy plant? Or are the difficulties previously referred to just a symptom of general tightening of the insurance market for complex waste-to-energy type plants?
Well, both SAF production and waste-to-energy are very difficult to insure right now. It's what's called a hard market, which basically means less supply of insurance and fewer underwriters willing to take on the risks. Both occupancies are challenging to insure. It is possible to insure, but defects coverage is the major stumbling block. If you want to get lots of cover for defects or damage following defects, the price differential can be quite significant. It can be 25% more expensive to get some defects coverage if it's available at all. You'll also be expected to retain more risk, so you'll have a higher excess or deductible for these sorts of facilities compared to other power generation or renewable energy projects. I guess it kind of depends what kind of SAF production facility you're talking about. If it's got hydrogen involved, then hydrogen can present some risks. It's obviously the smallest possible atom, so it can corrode and do all sorts of things to metals. It's also flammable. It burns without, you can't see it burning. So that is a major risk that insurers are worried about. You have to be able to understand these risks and explain them to underwriters. And it's proving to be a challenge. It's possible to insure these sorts of projects, but it comes at higher cost and with narrower coverage than we're used to from other forms of power generation.
Sandeep.
Hi, I'm Ravishan from Lensa Tech. I have probably a couple of questions. One is, is the panel aware of any feedstock insurance which like SAF plants can get, whether it's ethanol-based or waste-based? And secondly, if technology insurance is at all possible, any view on how much reduction does it do on the cost of capital, like especially if there's debt involved in the project?
So feedstock insurance, I'm sure it would be available. It's not something I've dealt with personally, but there is basically, if you want something insured and you're willing to pay a premium for it, someone will take on the risk. But it's at what price, and is it going to give you adequate coverage, or are you better off actually self-insuring a portion of that risk yourself and not transferring it by insurance, or is it a cost-effective solution for you? Sorry, can you just repeat the second part of your question? What was it?
The second was, if we get technology insurance, do you see the cost of like debt capital into the project going down, and if yes, then like how much?
Yeah, so I can't really give you a fixed number, but as part of the underwriting process, the guys that specialize in this, so Ariel Re, Munich Re, I think AXA, who Andy's part of, they will tell you exactly how much they can seek to reduce on your financing costs. The other thing it'll do is when you go and buy your sort of conventional property and casualty insurance, if you go to them with the technology risk insurance or performance guarantee, whatever they want to call it, there's lots of different branding names for these things now, it'll make that conventional insurance cheaper to purchase as well, because you've already got quite a lot of contractual indemnities from another source. Another thing you might want to think about is warranties from the suppliers. If you've got really good warranties from your suppliers, tell your insurers about them, because then the insurer doesn't need to worry about those risks because they're already contractually indemnified somewhere else.
Thanks, Andy. Any more questions in the room? Going back to the point about feedstock, do you see, like from a supply side, smaller and medium producers bringing together aggregation models to be able to get insurance in the market? Because as you said before, a small producer, maybe it's not doesn't have the size to go to get insurance, but maybe this type of aggregation models can be potentially a way to get insurance?
I think fundamentally, page 1 of the insurance textbook comes down to the law of large numbers, and the more similar risks you have pulled together, the more reliable the data sets will be, and it takes out the peaks and troughs that you're likely to see in the data. So that, as I mentioned before, is absolutely a collaboration that, in terms of presenting a risk to the insurance market, would probably increase the purchasing power and make the solution more commercially viable from insurers' perspectives, and with the volume, make sure that the pricing isn't done on a sort of bespoke case-by-case risk. You actually have a quantum of exposure pulled together, and that purchasing power would ultimately, I think, for certain underwriters, be more appealing than on a case-by-case basis.
Thanks, Andy.
Question for Charlotte this time. We saw last week that the European Advertising Standards Agency is investigating 20 European airlines in respect to greenwashing. What role do you see as broker to advise your clients in terms of reducing liability that may arise out of greenwashing?
So this is something that would likely sit in the D&O, directors and officers insurance market. Obviously, if you're taken to court for a greenwashing case and you're engaged in litigation, it can very quickly burn through your primary layer of D&O cover, just associated with the legal costs before you get to sort of the awards, etc. Yeah, I mean, it's definitely an area of focus for the D&O market. Again, I'm not I'm not in the D&O market, I sit on the aviation side. It also has serious reputational risk as well, and that's something that's actually insurable as well. There is reputational damage sort of insurance products available, and that's something that WTW can offer, and we actually, you know, are exploring particular sort of strands around climate liability. I guess the advice would be, you know, make sure that when you're making these commitments that they're achievable and measurable, and, you know, you're not making sweeping generalizations around what you're going to achieve. You know, they're realistic and measured. And then also, I'm going to steal this from someone else that I heard the other day, but don't mark your own homework. Make sure there's a third party involved that are kind of keeping you in check, I guess, in terms of meeting those standards and promises that you've made. Does that sort of answer your question?
Halfway, I think that, just on your point of D&O insurance, most D&O policies exclude any form of pollution risk. And therefore, an underwriter could argue that, you know, carbon emissions is actually a pollution risk. So, you know, in terms of advisory, I think the first thing, you know, I'm not giving you advice here, but it seems to me that the first thing should be done is to see whether those D&O policies actually covers this sort of risk. Would you agree?
Yeah, I mean, and as I say, this isn't an area that I sit in the D&O team. I mean, I think they're massively engaged in it, and our D&O team speak, you know, at events like this all the time around the considerations around it. It is a huge trend in the D&O market for sure, and it's something that they're watching, you know, with a close eye. But I don't think, I guess, to your point around it being a pollution exclusion, you know, whether it depends on what the angle of the litigation is. Is it not upholding your promise, or is it actually related to, you know, the emissions that you're emitting? In which case, okay, it could be considered pollution. But if it's just around false promises and misrepresentation, then I guess that's a different angle.
I was just going to add more broadly that I think the activist movement targeting the aviation industry is clearly a point of concern. And I think last year, the aviation industry was identified as the #1 industry that was now being targeted by the climate activists. So the kind of cases that we saw with the 20 airlines being sued for greenwashing, I think that's only the start. And as we look at the decarbonisation journey, I think the reality is if SAF starts getting implemented on scale, the activist movement may take the view, well, it's not the best solution. And then the point of focus will change from the airlines who are currently making advertisements, and those are being targeted. So fundamentally, well, you're producing SAF, it's the best thing that's available at the moment, but we don't think it's good enough. So I think that's something in the future for producers of SAF, something that will have to be taken into account as well.
And while it is deployed at scale, what challenges arise due to the varying regulatory frameworks globally? Do you see any challenges there?
Sorry, around what?
About having different type of frameworks globally, that there is no consistency.
I think it's the same as all frameworks and all. If it's not the same globally, then it creates challenge and complexity. And I think we've already discussed some of the topics which make it a fairly challenging and complex situation to deal with anyway. But going back to the Poseidon principles that the marine industry has, that is a leverage of consistency at an international level. So initiatives such as that can only help. I feel all of those frameworks, though, have to come from outside of industry, because ultimately, if you leave the insurance industry to set its own benchmarks and frameworks, you'll start to see different underwriters and insurers and brokers backing different initiatives for competitive purposes within the market. So fundamentally, that collaboration is required across policymakers at a global organization, whether it's ICAO or IATA, and then underwriters, financiers, etc., need to take the lead from those international standards. Otherwise, in my personal opinion, you'll never get consistency because a different framework may be a competitive advantage or disadvantage for certain players within the market.
Yeah, very interesting. So if I understand correctly, you see that there is a role for underwriters to play in advocating for consistency and for supportive regulations, right?
100%, absolutely.
We have 2 more minutes. Any other questions? Okay, so this is the end of the panel. Thanks to Charlie, Rob, and Andy for sharing their insights. And thank you for all being here today. Your questions enrich our discussion, and we seek to better understand how insurance can play a pivotal role in advancing sustainability within the aviation industry. We invite you to the next session in this room at 15:40, entitled Founders' Perspectives on Raising Finance. Enjoy the rest of the day. Thanks.
Airlines and aircraft makers are desperately searching to reduce their climate impacts. CO2 emissions amount to about 2% of the global total and 7% in the UK, and are increasing. But there are other impacts, such as the damaging contrails. Back in 2011, I was granted a patent for a novel way to generate power and hydrogen from hydrocarbons. Highly efficient fuel cells and electrolyzers make this possible. Using this patented process as a front end to a more conventional gas to liquids process, we can turn all sorts of worthless waste into high-value fuel, help clean up the environment, and solve the problems of disposal in one fell swoop.
Making sustainable aviation fuel in sufficient quantities is a massive chemical engineering challenge. We've already started building our bench scale system, which will just prove the concept. So we'll take some waste, which is our feedstock, and we'll create some fuel to demonstrate that the process actually works. The key step is then our demonstration system, which will be a 5,000 ton per year plant, and that will be a very faithful reproduction of the larger scale plant that we're going to scale up to. Then we're going to scale up to our 30,000 ton per year commercial plant, where we're making fuel, selling the fuel and making money for the business. Jet fuel is a tightly regulated product. In our case, we have to meet those requirements, but we also have to meet the requirements that it's sustainably produced.
Reducing global temperatures and protecting our planet is a key generational challenge. Our mission at Aviox is to deliver the world's most technologically advanced refinery making sustainable aviation fuel. We believe that the plant will be highly profitable due to the very low cost of the waste materials as input material. We need the resolve and the capital to make a radical shift within our economy to make it modern, circular and sustainable. This is a once-in-a-lifetime opportunity to join a new wave of clean tech companies developing clean, green and sustainable aviation fuel, and it's a privilege to be part of it.
Airlines and aircraft makers are desperately searching to reduce their climate impacts. CO2 emissions amount to about 2% of the global total and 7% in the UK, and are increasing. But there are other impacts, such as the damaging contrails. Back in 2011, I was granted a patent for a novel way to generate power and hydrogen from hydrocarbons. Highly efficient fuel cells and electrolyzers make this possible. Using this patented process as a front end to a more conventional gas to liquids process, we can turn all sorts of worthless waste into high-value fuel, help clean up the environment, and solve the problems of disposal in one fell swoop.
Making sustainable aviation fuel in sufficient quantities is a massive chemical engineering challenge. We've already started building our bench scale system, which will just prove the concept. So we'll take some waste, which is our feedstock, and we'll create some fuel to demonstrate that the process actually works. The key step is then our demonstration system, which will be a 5,000 ton per year plant, and that will be a very faithful reproduction of the larger scale plant that we're going to scale up to. Then we're going to scale up to our 30,000 ton per year commercial plant, where we're making fuel, selling the fuel and making money for the business. Jet fuel is a tightly regulated product. In our case, we have to meet those requirements, but we also have to meet the requirements that it's sustainably produced.
Reducing global temperatures and protecting our planet is a key generational challenge. Our mission at Aviox is to deliver the world's most technologically advanced refinery making sustainable aviation fuel. We believe that the plant will be highly profitable due to the very low cost of the waste materials as input material. We need the resolve and the capital to make a radical shift within our economy to make it modern, circular, and sustainable. This is a once-in-a-lifetime opportunity to join a new wave of clean tech companies developing clean, green, and sustainable aviation fuel, and it's a privilege to be part of it.
Panelists on stage. Come on, folks, come and grab a seat. I'm afraid I've not organised a drum roll, so... Oh, we got the start of a round of applause. That's a good start, isn't it? You're far too generous. I'll take this seat, just position yourselves down the line. Now, some of you probably can do some simple maths and realise we have got an empty seat on stage. And the reason for that is, I don't know, do you remember when you were an early career person? Doesn't necessarily mean you're young, it just means you've changed career and you've been going to the trade shows and you've been going to the conferences and you sit there thinking, why are they on the stage? Well, we've got an empty seat, so if there's anybody who is an early career person, I welcome you to take the seat and join us on stage. It's your opportunity to share thoughts on the topic, and for those of you who are wondering what the topic is, it's all about early stage investment and being an entrepreneur. And the other thing I'm going to give the room is, in the event that any of our panelists, including our guest panelists and definitely including your chair, you feel that you could contribute more to them, I want you to come and tap me on the shoulder and take my place. And I will let you run the panel, and I'll let you join my panel, because this isn't us talking to the floor, it's us talking with the room. So anybody want to join us on stage today? I'm always worried when we have entrepreneurs who lack courage. You know, I mean, I think there has to be a certain amount of cheekiness if you want to be. Come on, you two are looking at each other in a rather worrying way. I think if you're going to be a successful entrepreneur, there has to be a little bit of cheeky people in you, hasn't there? Excellent. We've got an empty seat for now. Right. If any of you change your mind during today, please come and join us. The seat's over there, absolutely no problem. What I'm going to do next is I'm going to ask my panelists to do a brief introduction, 3 to 5 minutes, about what they are, where they've come from. I've got a few questions, but I'm really looking for you folks to throw questions towards us and get the expertise. In a nutshell, we've got 2 VCs, 2 investors, and we've got 2 entrepreneurs who've been on a successful journey. And what we're trying to achieve today is we're trying to share the learnings, the lessons, to stop you folks making some of the mistakes that we've made. I'm going to start with myself. So I'm Ian Tracy. I am the CEO of Anchored In. In a nutshell, I've traveled the whole innovation journey. I started as a research scientist. I worked for blue chips taking products to market. I've worked for investors. I've been invested. I've worked in government science and done technology transfer, all that good stuff. Next up, Patrick, would you be kind enough to introduce yourself for 2 to 5 minutes?
I can. Firstly, thank you. My background is as a CFO in venture capital world, probably about the last 20 years. And most of that time, it's been learning, making mistakes, and journeying my way through. Probably the most relevant one I've dealt with is a company called Oxensus. I turned up there in about 2008, thinking, fine, this should be an interesting journey. 16 years later is when we sold the company. Oxensus it dealt in the aerospace by putting optical instrumentation into jet engines. You don't normally do that overnight. In fact, I don't think I really want to see anyone undoing an engine, putting new instrumentation on when I'm about to fly off overseas. You test, you test, you test. So at Oxensus, I joined when there was probably about 15 people. We ramped up, we ramped down. Then we slowly built our way up again after forging relationships with people like GE Aviation, Parker Hannifin, and working our way through. And it took a long, slow grind before we could finally exit. But that was the journey we went through. It was a great journey, painful journey, loads of mistakes, but we end up succeeding. That would be my summary of myself.
Thank you, Patrick.
Hi there. So Ayantika Mitra. I'm Director of Strategy at an SME called Tysex. So Tysex pioneers lightweight advanced materials for aerospace systems. So working with the large sort of primes and tier ones like Rolls-Royce, Safran, UK and European space agencies. So a bit about what makes Tysex special. It's advanced materials, so you can take a tube of the material, which weighs the same as a packet of crisps, but it will carry 1 African elephant. So incredible technology, incredible material. And when you apply that to things like aircraft, you get 50% lighter systems. What does that mean? 50% less CO2. So it helps sort of SAF-powered aircraft, hydrogen-powered aircraft, and on just applying it on landing gear alone, you'd save about 9 million tons of CO2. So I sort of mentioned I'm a strategy director, so what do I do in a small business? That encompasses pretty much everything. So everything from strategy to financing, looking at operations, also stakeholder management. I guess a bit about my background. Really, you can split into 3 parts. Started out in the professional services, so as a management consultant, sort of showing organizations, helping organizationals sort of carry out their transformational change agendas. Brief stints at investment banking, and decided that really wasn't for me. I wanted to actually go build things. So started a manufacturing business whilst at university, did that for several years. So everything from setting up a factory with having no experience of doing so, to sort of patenting products, distributing them. That sadly didn't work, but again, I think in the UK we're so, we have a different relationship with failure than, say, in the US, where they're more open to it. But sadly, that business did fail. But actually, that was one of the most incredible learning experiences I've had. And then so that was the startup phase, and then the final I guess, the next phase really in the scale up. So I'm currently at Tysex, and really helping the business to scale, to grow from where it is today. So a couple of highlights, I guess, for me, for the last couple of years, raised about 9.5 million in funding. When I say raised, that doesn't mean private investment. It is other forms, whether it's debt, whether it's grants, or it's customer funding. And I think one of the elements we sometimes don't discuss enough is actually going and pursuing customer funding. So did that represents about 70%, did that over the last 4 years, represents about 70% of the funding into the business. We managed to acquire 2 businesses, technologies. One was a competitor who didn't do very well out of COVID, and also a technology license from Rolls-Royce. So really growing the business through other means than just organic growth. And yeah, so also one of the things I would really recommend to people is maybe doing increasing your management skills, like doing an MBA, a part-time MBA, and there's a number of free courses, etc., that are available. So really highly recommend that. So yeah, happy to discuss any of the funding journey and pains and joys through it.
Cool. Sarah?
Hi everyone, so I'm Sarah. I'm an investor with a fund called Zero Carbon Capital. I'm a scientist originally, so I have a PhD in bioprocess engineering. And then I left the lab and worked in university technology transfer for a couple of years at Imperial College and then Oxford University. And then I moved on to lead the Climate Accelerator program with the Creative Destruction Lab. So that's an accelerator for very early stage science-based startups. And then joined Zero Carbon Capital a couple of years ago. So we are a pre-seed and seed fund for scientific innovation in climate. So we invest the really early stages, often the first investor, for scientific entrepreneurs who are tackling the hardest problems of decarbonization. So the things that we really think are going to have a huge impact in terms of emission reduction potential. And this is our second fund that we're investing from now. We invest across Europe. We had a first fund, which was UK-focused, and we had 7 portfolio companies from that fund, all of which got follow-on funding and are doing really well. And we've invested now in another 8 companies in Fund 2, and yeah, have another 10 investments to do this year. So yeah, that's us.
Thanks, Ian. So my name is Nicola Sinclair. I'm managing partner at Twin Track Ventures. So my background is I spent almost 20 years inside defence in the UK's Royal Air Force. I set up a corporate venture capital in there, and during my time in that CVC, I backed 2 SAF companies, one of which is here today, so it's good to see them carrying on with their journey. After leaving the Air Force, I joined a deep tech fund in London and set up a dual-use track for them, investing in some energy companies, and then more recently I've set up my own firm, as I say, Twin Track, which is again focused on dual use, but takes forward that thinking around energy. It's a pre-seed and seed fund, a bit like Sarah says, where the portfolio size is slightly smaller, but backing deeper tech companies, science-based companies, and really looking to try and support people at that very earliest stage, connecting with government, which can be a really difficult customer, particularly in the middle zone, but can be brilliant at the beginning of your journey, or toward the ends of your journey when you're slightly larger and looking to scale geographically, because actually it's a great community that can support you moving from the UK into other territories, particularly in the US and Australia.
Thank you. If you want to ask a question at any time, please give me a signal I can see from here. Raise a hand, wave, stand up. It doesn't matter. We'll get a microphone to you. In the meantime, I'm going to ask a question around teams. I want to ask our 2 entrepreneurs, how did you build a team? How did you what were the difficulties, challenges, highlights you saw from building a team from 0 upwards? To our 2 investors, I'll be asking the question from the point of view, what do you look for when you're looking at a team? What are the red flags? And what's the opposite of a red flag? Green. Oh, that was quite easy. And the green flags that you look for when you're analysing a team.
So I would say that's probably, for us, it's been the single hardest element. What we do as a technology is really, really difficult, but that's really simple compared to building the right team. And so we had to, in fact, the last 2 years actually sort of get Patrick's help to help build up some of the financial sort of competencies within the business. So really difficult, especially in the UK. I think, we really underestimate the skills base that we have. You can almost get the technical skills, but to some extent, are you being able to attract the management skills as well within the business?
So you said, especially in the UK. What made you say especially in the UK?
So I would say that in the US, for example, you have more people who have both the technical and managerial background.
Okay.
So you have people, and because their degrees their undergrad degrees are wider. So in the UK, we specialize quite early and we stick to that in terms of the undergrad. So people's sort of experience base can be more limited than in some other sort of regions. But I would say that's the single bit hardest element. We've been quite lucky. So we've made use of sort of programs such as the engineering doctorate program. So actually that's been our core talent pipeline, is getting people from, rather than getting a PhD from university, they're actually based within the business. They are there for 4 years. They really understand your technology. And they build up that competence in solving a problem. They're also getting a doctorate out of it. But actually, for example, we have 2 core technology areas. They're both being run by people who've come through that track. So it's really thinking about what are sort of the appropriate sort of channels, what's available out there to help you sort of, get the talent you need. And, for us as a small business, we're competing with the likes of BAE Systems on our doorstep. So it's really hard. So we have to do something different. So we try and do things like that. Also look at sort of potentially doing a guest lecture at university if you're a very technology-heavy business, and just try and get, some of the cream of the crop and influence them to sort of come and join your organization. So there's a couple of things you can do to be a bit different, especially when you're competing against those large companies with great graduate programs.
And it's interesting you didn't mention money. You mentioned non-money there. Patrick, one of the things you've said, you've gone up in a company, you've gone down in a company. Are you able to give us some experiences of when you're going down in a company? But answer the first question first if you want.
I'll deal with both. So in regarding culture, groups, and all the rest, probably the biggest part I find is not dealt with enough is the management of people.
Okay.
And you can get some great scientists, great engineers, really clever salespeople, and then you've got to get someone to actually manage them.
You mean treating human beings as human beings?
Dangerously, yes. But it is. Most of the problems that come through is you start off with 2 or 3 people grow a company, and you slowly grow, and then you get a bit larger, and a bit more larger. And then suddenly they've got to deal with someone who's might have a happy event, child been off, and they want paternity leave or maternity leave. And hang on, that's a gap. How do I deal with that? How do I deal with someone who says, I just want to leave, I want to turn over?
Yep.
And that's often, for a lot of entrepreneurs, it's the very first management job. So that's one aspect. The second part is you grow the team larger. And you've got about 30 people, which means you need that dangerous part called middle management. And you can find a really clever engineer, really clever salesperson, really clever, occasionally accountant. But the issue is, can they actually manage other people? And how do they run that team? And it's often, I personally find, not looked at enough. And it's the part that makes the company run and hit targets really, really well. That's one observation I find often gets missed in startups.
There's almost a lack of, I don't want to put words in your mouth, but it feels to me you're saying there's almost a lack of professionalism in the way that our middle managers are chosen in some of our startups.
I think they're just underrated. It's that oil that makes the company run. It's that grease that runs through. You have a nice set of machinery. You won't forget about putting the grease in the engine.
Yes, but I also think there's a challenge that you can't take middle managers from, you mentioned Boeing, Airbus, you can't take a middle manager from somebody like Boeing and put it in a startup. That'll be a bad day out.
And that's the other part. If you bring a manager in, if they're not experienced to the grey world of a growing company in that sense, a rapidly growing company, they don't deal with uncertainty well. And that is a problem. So how do you find someone who, A, is versatile in mind, B, can adapt, C, has all the other talents where they know something's out of kilter?
Yes.
That's not easy. So That would be my observation regarding teams. If you can find either the entrepreneur who knows how to manage or to step aside for a manager, that's important. And if they're growing the company big enough, how do they effectively insert someone who can alleviate the team?
Fantastic. Okay. Should we go to the VCs and we'll come to, using the wrong mic. I'm going to look at the room and see if there's any comments. We have a hand up over here. Or is that a question from the chat?
While we wait, oh, there we go. Just a question for you, Patrick, sort of on the back of what Ian's just touched on there. You mentioned around ramping up and ramping down. I'd be really keen to hear about how you communicated those changes to your stakeholders, whether that be investors, customers, and also how you adapted your financial strategy and your funding strategy during those different periods of time.
So take the ramping down. So I joined in 2008, Oxensus rising. Then we got to 2012, and bottom line was we found the company wasn't commercially where we wanted it to be. We could not dictate fast enough in the aerospace world or the energy world for us to get the product out in time. Cut through it all, that's what it was. So we had to cut the team back down a little bit into a holding pattern, and at the same time we forged a couple of strategic partnerships. Get ourselves to a cash break-even position. So that was done in conjunction with our board, where the board, representing the investors, had to give up some IP. Now, it was in areas that we didn't think were fundamentally an issue for us, i.e. we're giving up side IP, not core IP. So that worked. But the investors were bought on. From their point, it was going, we can't keep funding indefinitely. So you've got to come together with an intelligent plan on that side. The next part was, hang on, I don't need 30 people. And that worked from the founders downwards. Everyone had to take pain along the way. There was no good one person sitting back going, well, I'm going to stay here and not the rest of you. Everyone took pain. How we presented that staff, it was done quietly together, and then we had to walk through the redundancy process. But it was done in one go, but it was clear it's one cut. We're not looking for a second cut. We're not in a death spiral. Same time, it was presented alongside that, here's where the upsides are. And that was with our collaborative programs. So we had the upsides, we had the investors bought in, but we made sure the pain was shared equally between everyone. Okay?
Thank you. I'm going to bounce to our investors for the red flag, green flag question around when they're looking at a team, how do they form their opinions of the team on the other side of the table? What worries them? What makes them happy?
Sure. So I guess it often for me starts online with the first call, and I'm really looking to see how that person's presenting themselves and how they come across and just the feel I get for them. It's quite a human thing. I don't have a grid. I don't have like a scoring matrix. I'm just looking to see, do I think this person's presenting well? Are they organising the information clearly? Do they come across in a way where I think other people will invest, other people will partner with them? It's a very human reaction. One thing I always try and do with a company when I'm looking to back them is try and meet not only the C-suite, but also people who are on the edge of that C-suite, who might be emotionally very significant or in key roles in that company. And actually, I spend a lot of time trying to sit back and really watch their body dynamics, their body language, their actions as a group, and really get a feel for like the power relationships between that group. Are they behaving in a way that feels quite controlled? Is this some sort of benign dictatorship? Excuse me. Or actually, are these a group of people that will weather a storm quite well? Because I often see people really early on when they're maybe buzzing from having raised an amount of money, having got their idea to the stage where they formed a company, but there's such a long journey ahead of them. And then, I'll be really honest, I actually spend a lot of time triangulating people with mutuals, with their online content. That's getting easier and easier with the powerful tools like LinkedIn, where I look and comb through what they've said publicly. I look at the comments they've made on posts, and I really try and get a feel for how this person is going to behave in the public eye and kind of where are they positioned in their view, not only on their company and their industry, but like how is this going to work going forward for the company as it becomes a big, visible entity. And on your point, Patrick, actually, about finding those people at the intersection, if you are looking for somebody that can help you, I strongly encourage you to consider people in the veteran community who've done roles like military advisor, adjutant, or chief of staff. Those people are absolutely amazing at holding a lot of stuff in their head and being that human interface between different stovepipes in companies.
Just building on what you said, I think I will say I'm not adverse to ringing up people I know as mutual contacts for an informal reference. I've done that on more than one occasion. I wouldn't be surprised if our panelists have as well. Sorry.
Yeah, so like I said before, we invest in scientists who are entrepreneurs. So they have to have the scientific skill that's relevant to the technology and the company they're building. And that sort of thing is more straightforward to analyze. You look at their background, their qualifications, the papers they've published, that sort of thing. So a lot of that can be done on paper. And then it's seeing if they have the entrepreneurial sort of aspects of it, and that can be more difficult to analyze. So it takes a lot of phone calls. It's essential to meet founders in person, I find. Then you pick up on a lot of the things that you were sort of saying that's important to figure out from a founder. And then what does it mean for to be a business leader? So what are the sort of qualities? One of the things is really strong communication skills. And you touched on that as well in terms of how organized they are, in terms of organizing their thoughts and organizing the things that they're presenting. But it really is a huge role of the CEO is to sell. First of all, selling to other investors and raising their rounds, but then selling to customers. So that one, they have to have the communication skills to really pull that off. And two, they have to have the passion for it. Because it's a long and hard journey, raising a round and bringing in customers. So they have to be willing to repeat themselves and tell their story over and over again. So I think that's really important. And then, yeah, how the team interact together as well is important. And I think meeting at least the founding team in person. Usually I go to their lab and get them to show me around their lab, and you can pick up on some of those dynamics with them doing that. And then, people talk a lot about sort of resilience and endurance as a founder quality and as an entrepreneur. And that can be hard to sort of assess in the very early stages. You need to know them for a long time. But you can sort of pick up some of those things if you sort of push them quite hard on some questions and see how they respond to being challenged on things. And that can indicate that. And that indicates two things, actually. One, their sort of resilience to people opposing them and things going wrong and people misunderstanding them, but also their coachability. So how able are they to take it on and say, actually, I'm doing this because I really believe in it. I see your point, but I'm doing it for these reasons. Or, oh, I see your point, I'm going to go away and think about it and maybe adapt. So those are also really important qualities.
Thank you, Sarah. And so, building on one of the points you made, that you were talking about how the founder communicates with the investors. Do you have any thoughts on, say, the frequency, the depth? I mean, can you be over-communicated? Can you be under-communicated? How would you like your ideal founder to manage you?
Yeah, and I think this will probably vary from investor to investor. For me, because we're investing in deep tech companies, I really want as much detail as you are able to share. And something that's probably true of all investors, we want transparency. So might be a temptation for founders to send a sort of high-level, very shiny sort of deck and continue to sort of market yourself in that way. I think as soon as possible, be as transparent as you can with all of the good things and also the risks. And anything that's a bit unusual. The longer you hide that from investors, the longer the due diligence process is. And those things might not be no, that might not lead to a no from an investor. It's just so much easier if I know it up front, and then I can discuss it with you and say why we think it's a risk. Do we need to shift things around? Or maybe it is a no, and then I'm not wasting your time. We can just say it from the beginning. So I really think key thing is transparency. And then, yeah, frequency of communication is hard. Do send as much detail. Some investors prefer talking on calls more often. I prefer a combination of written things and calls to then go through written documents. But I think that's
So I think it's easy as an investor to say we want full transparency. It would be interesting to ask our two startup founders, do they think it's necessarily wise to have full transparency? Because I can see the advantage from your side, but from this side, has full transparency ever bitten you or somebody you may know?
It's how you communicate it.
Okay.
At Oxensis, we always had the rule, bad news, you get out early. However, you'd still wait and 24 hours, sleep on it, make sure something hasn't changed overnight. But we're clear in the sense that if there was bad news, we would present, because people need digest. We're working with clever people as investors, treat them as clever people. That said, there was an element of how far do I need to go down? If I tell an investor something, is that going to materially change the world? Yes or no? And we make the judgment call, because my job partly is, yes, to make sure the investors are happy and there, but actually my other job is make sure the company runs, and you only got so much bandwidth. So there's an element of, I've sat there writing wondrous reports for the board and the investors, and it's merrily gone to sleep. And that's nice, that's the way I've communicated, I've told them the bad news, I've gone in depth, but they couldn't change it. We had to run another test on one particular program. So we could have done a lot more summary data, showed them, got on with it, and moved on. But there's an element of, if I'm spending all my time speaking to investors and I'm not careful of the level of detail, I'm not doing the rest of my job.
I like the idea of sleeping for it for 24 hours, because in my experience, if you communicate too soon, your raw emotion is getting mixed up with the message, and that doesn't sound like leadership. Whereas if you sleep on it overnight, you understand what you're telling people, and I imagine more leadership is felt on the receiving end.
Yes, it's very much sleep, see what data settles, go with a calm head. You know, you're delivering information, you're not delivering a passionate speech. At that point, you know, by the time the investor's on the board, I'm trying to give you information, not trying to persuade you. I'm not in marketing mode.
Well, that's another key point, isn't it? You're not in marketing mode when you're talking to your investors. It's a dialogue, not a sales.
It is, because sometimes they have the answers. Sometimes not. Depends what the story is. If I'm doing corporate finance, they have, often the VCs will have a range of contacts, or occasionally I need a specialist. You know, yes, they invest, but they're also, crudely, a resource. How do I get the best out of them? What do they know? What don't they know? How can they help me? Not just in cash.
Yep.
So it's a two-way street.
Excellent. I'm looking at my two panelists who haven't spoken if they want to add. I'm looking at the floor. Is there anybody who wants to come in with a question, comment, or challenge?
I'll happily add to that. I actually feel also it depends on the type of news and the type of relationship you have between the investor, like your lead investor and the founder. So I tend to end up with a relatively informal relationship. My portfolio is relatively focused. So actually quite often I get a WhatsApp saying, hey, like we need to talk. I'm not really always sure if that's like I'm having a baby or there's a problem with the P&L or something. Like it's a bit unclear sometimes what that means. But I really appreciate finding out things before the board. I actually really don't like getting the board pack and discovering there's a major issue, because then I'm on the spot. I can't always be as helpful as I'd like to be. Sometimes I needed a bit of time to think about the problem too. So actually I really appreciate proximity to my founders and that level of transparency where they're like, I don't really know what to do about it yet, but this has happened and I'm working on it. Quite often that's actually a really great place to start for our relationship.
So finding it on page 5 of the monthly report pack would be
like hidden on some sort of PowerPoint in an incomprehensible diagram where I then have to specifically ask about it at board is probably not going to be great going forward.
Thank you.
I think sort of when you're doing the pitches to investors, you know, you kind of have, well, at startup, you sort of have a mentality that it's a bit of a dog and pony show. You've got to put your best foot forward and put on this show, etc. But also, so yes, you're in sell mode, so you've got to do that to some extent. But also it's remembering that ultimately, if you want it to be successful, sort of long-term, it's got to be a successful long-term relationship. You know, you've got to be able to work with them. And at the start, particularly before you've had investment in, there is a huge sort of information asymmetry, right? So you know all of the details of your business. The investor knows actually very little, and you've got to be able to transfer enough information over to them for them to make an informed decision. But actually, what you don't want is for them to have surprises. So it's really on, So it's important that whilst you're selling, you're also keeping it, in the back of your mind that you want a relationship, sort of an honest relationship, and have a good relationship with your investors, potential investors. So it's making sure that they don't have surprises, etc. So talking them through it. So I think communication is really integral. And it's not just a sales process, but it's a long-term process. So communicate, adapt, I think, from the first sort of meeting, then start to adapt your communication style to something that will enable that longer-term relationship.
Okay, thank you. So where I want to go next is, I think a question that often comes up in early-stage investment is valuations. I'm going to be asking our investors, are there any models that they commonly use? I mean, MBAs give you many, many models. I think it's an interesting combination of models plus human. So I'm going to ask you two if there are any models that you actually use. And I'm going to ask our two founders, what takeaways do you have from the valuation time? Anything you want to share with the room, anything you regret, anything you celebrated? So I'll start at the end of the panel down there. Are there any investment valuation models you really do use?
So I'll be really honest, I'm not sure that there's ever one particular approach here that rules them all, but one thing I'm really in favour of is getting the cap table out and looking at where the founders are and looking at what valuations mean for their ownership, their percentage ownership going forward. So I think one thing that certainly introduces, and we've talked about red flags, green flags, I think there's an amber flag that's worth regarding in this format in the cap table. If you're a deep tech company, if you have technical risk and commercial risk, if you then have an overly diluted founder, and what I mean by that is not at market for their stage or their sector, that is an amber flag. And it's an amber flag you and your existing investors can manage. So one thing I look at doing, particularly when a company comes to me and says, hey, we're targeting 40 million, and I say, actually, I think you need to be at 10. The reason I'm saying that is not because I want to increase my percentage ownership, it's that I want to put their percentage ownership at market, nothing more, nothing less. And that's a very data-driven number. That's not something I set, that's something that's come from market data. The reason I do that is to make sure that that's like a neutral thing for follow-on investors. There's no amber flag on that cap table, because to me, I think that's a really, really fair way of dealing with valuation.
It's fantastic you're using the word fair, though, isn't it? I mean, if you take the stereotypical view, some people will suggest that one side of this equation is trying to push the other side down. So to hear you using the word fair is a delight.
Yeah, I mean, I want the company to do well, right? Like, it doesn't help me if the valuation is in a bad place and they don't get follow-on. Like, I don't deal really with secondaries. Like, I deal with successful companies. And I think a big part of that is by making sure that cap table is good and that people are in a good position to benefit from their hard work.
Thank you. Any models?
So we look at market comparables.
Using something like Bowhurst, I guess?
Yeah, exactly, PitchBook, and so we get some information through that. But I also really want to strongly reiterate what you two are both saying, that we don't set valuations or propose valuations in a sort of greedy sense to take as much of a company as possible. We want a valuation to make that company healthy. So it needs to be something that makes sense in terms of other companies at their stage and in their sectors. Like, is it at market? Is it going to be an issue with the other investors we want to get on board? Is it going to be an issue at their next round? Where can we set it so that they're on a good journey? And also so that they can grow and that the next valuation they get is an uptick. And so not overvalued, but also not undervalued. And that's looking at market comparables, but also talking to the founders, and if there's a syndicate of investors, talking to everybody. And there's the valuation, but then very importantly, like you said, it's the ownership. So we look to take 5 to 10% when we invest in a company, but what's more important to us is a valuation that makes sense and a healthy cap table. What's very important to us, and it would be an amber flag, but it would go to a red flag, actually, is if the founders have less than 50% of the company after the seed round. So if they're already diluted below 50% ownership, that's a problem.
And for clarity, that's 5-0, isn't it?
That's 5-0.
Yep.
So they need to have half of the equity in that company. And preferably still they have that at Series A, actually. But if they're already down to less than half at seed, then that's going to be a problem, probably. Because that's going to be hard for them to convince later stage investors that they're incentivized enough as leaders of that company to continue building it.
It's fantastic to hear that. I'm going to ask our two founders to see if they share that, if they've shared that experience.
You need to make sure the team is well aligned with investors.
Yes.
That's probably the most fundamental part. Whether you get 1% of a trillion, happy days, or whether you need 50% of something else, you have to work that maths through. And not, as you say, not just this funding round, but what about the next one, and possibly the one after that, depending on what business you're in. If you're in heavy deep tech, you're going to require a lot of investment. If you're in a software business, you may scale that a lot easier, a lot quicker. Mm-hmm. So it varies. I'll talk outside making sure the staff, and I mean all the staff, are aligned with investors. Probably the other part I'd say is when you look at an exit, don't delude yourselves.
Okay.
It's very easy to go, I'm worth a fortune. End of the day, all you're going to get paid is the amount someone's willing to pay, and that's about $1 more than the next person. So the harsh answer is, when you head up towards valuation, certainly if you're in a deep tech industry where you don't always have profitability, mm-hmm. Yes, if you can sell yourself for a strategic purchase, happy days. If not, then you're going to run into you may have to use the discounted cash flow method. One day I may get X. Otherwise, you're in the dirty little area called profitability and multiples of EBIT and multiples of sales. And that's not so good if you're in a deep tech industry. So
no, you've no sales really, have you?
And a multiple of EBIT's often a negative number. So you have to work that part through and make sure you position yourself. Yep. What are you worth to the person buying you? And make sure you've got competition on that part, because there are no models of that part.
That's something important, though. If you get more than one person who's interested in you, the balance changes, perhaps?
It does, and you effectively got to make sure that it comes together at the same time, and that's the hard part. How do you keep two parties interested? You see it when you're raising funding. It's no different when you're selling the business. So,
okay. Thank you. Any thoughts, or shall I find another question?
I guess just a quick one addition to Patrick's sort of comment. So TISIX hasn't raised sort of external private investment, but we've obviously gone out to the market, talked to a lot of VCs, et cetera. And I think one of the things that deep tech businesses forget is that you have a long, and we've talked about this already, but you've actually got a long time horizon before you're making a return. What does that mean for your investor? And really understand what that means for your investor. Because actually, your return, you're looking at sort of 10 plus years. Now, most investment funds, do not have that horizon. They have to return capital to their investors in 7 years, 5 to 7 years. So just make sure you have that sort of understanding that, your timescales are aligned, and be really honest with yourself about it. Because I think there's no good sort of spending a whole bunch of time, energy, and resource trying to get investment when actually that might not be the best route for your business. Or maybe you need to look at CVCs, or you need to look at, getting sort of a customer to sign up to offtake agreements or whatever else, commercial sort of contracts, and just be, I guess, realistic about, is venture capital investment the best route for your business? Because you have to make a return in a given period, and you've got to make, X return, because that's the model that, you're working with. So just being pragmatic on that.
And to clarify, CVC's corporate venture capital? And offtake agreements, effectively purchase orders from other people to buy stuff. Cool. I believe we have a question in this corner.
Yeah, hi. I wanted to ask the panel about your thoughts on the use of employee option pools. Is there like a sweet spot where you consider it to be sort of the perfect amount put aside for an employee option pool? Is there a point where you think, oh, that's not enough incentivization? Or is there also, on the other hand, a point where you think there's too much that you've put aside there? Thank you.
I think what I've seen most commonly is around sort of 15% for options, but I guess it ranges maybe between 10 and 20. I don't know if you've...
So yeah, I agree. 10 to 20 is normal. I think at market is 10 at the moment. I think that if it doesn't exist by Series A, it needs to at that stage as well. I think one thing I found a bit heartbreaking when I've seen deep tech companies I particularly liked is when the structure of an ESOP has been put in place and founders have used very early alternatives, and they've just overly diluted themselves with people who've come for maybe 6 months or less than a year. And so they've really tried to embrace the idea of a stock option, but they've structured it in the wrong way. And as a result, as a VC, even if I love the founder and I love the technology, doing all of that restructure is really, really painful. So I think if I could say anything, if you're not sure, you can always come back to it at a later stage. You know, this is somewhere where a good, healthy relationship as a group and say, like, this is what we're going to negotiate. We can now legalize that later. We can make sure that's set up at A is better than trying to put other structures in place too early and then overly diluting yourself as people cycle through a very early company. But it's truly heartbreaking when I see that.
Thank you. Looking at the room, we have a question at the back. You need to wait for a microphone because there's people hearing online.
Thank you. My name is Inge Berge. We are setting up a plant up in Sunderland we call Wastefront. But I've raised a lot of money before and started a few companies before, also public companies. What I'm really wondering about is, you know, introductions into investors. Mm-hmm. Is it good to bring a bank along with you? Is it better to have some, you know, there's a lot of people that do introductions into investors. What's your experience with that? Because I can't really get what is the best.
So there's two questions there, isn't there? One of them is, how do you feel when they bring a bank to them? And the second one is, how do you feel about introducers, presumably for money, making an introduction?
And especially in the SAF area, you know, it's quite a bit of money that needs to be raised.
Yeah, a small percentage equals a big number, doesn't it?
Yeah.
Yeah, so when I'll start with the introducers question, I've maybe got a stronger point of view on that subject. I actually really don't like it. I feel like a good founder finds a way to contact VCs direct. I think that's becoming easier and easier, as I say, with tools like LinkedIn, where you can scour quite a lot of resources, Medium articles. A lot of VCs are really active, like writers. And I think one of the things that the community relies on is like sharing deal flows. If a good founder comes to me with something and it's not right for TwinTrack, I will send it on to somebody else I know is active in that space. I would much rather somebody cold approach me with a clear explanation of why they are approaching me, why they think their technologies are fit for the thesis. Sometimes that can be hard with emerging managers, because if you're still continuing to raise your fund, you have to be really careful about how much content you put on the internet. So if you find a VC fund has like a very blank page, it's because they haven't completed their own fundraising. And I think in that situation, you can be forgiven for being less clear on exactly where they're positioned. But most established funds are really, really clear, but yet you still see a lot of approaches from people who aren't a thesis fit. So I think that doing some research on who is a good fit for you, who is active in that space, looking at some of the research tools that have already been mentioned and narrowing it down. But if you can find an intermediary, great. A warm intro goes a long way. Like on bringing a bank to a meeting, I've never had that. I've certainly had people explain how they're going to finance alongside a VC investment. I think that structure is really helpful. I don't think you need it at a first call, is my point of view. I think that's maybe it feels a bit overly keen to have something lined up for sort of a day one intro call.
I'm just going to add to it, you've got open VC lists, haven't you, if you want a list of investors. And I always urge companies, no matter how bad the investment meeting goes, the closing question might want to be, can you tell me which other investor might be interested in this?
Yeah, I agree with both those points. So we also really don't like it if there's a sort of third party doing the fundraising on behalf of the founders. We really think that that's the founder's job. Particularly pre-seed and seed and A, maybe in the later stages, there's a bit more leniency in the VC world on that. But yeah, for us the same. I want to speak to the founders and hear from the founders, not from someone else. And also, I've not seen a bank in a meeting, and it wouldn't make any difference at all to our decision. If a bank was there, it would probably make it a bit awkward. But again, it depends on the stage, because we're investing pre-seed and seed. If you're talking about these really high capital, hard tech, SAF companies in the future, then those conversations about what other kinds of funding are going in alongside the venture capital money, then yeah, but I wouldn't take the bank to the first meeting, but I would, you know, tell the VCs you're looking at other types of funding. At the pre-seed and seed stage, what I would show is grant money. VCs love, because it's great for everybody, it's great for the founders, it's great for the investors, it's great for the company if there's a lot of grant and non-dilutive money that's going in to support the tech development of that early stage company without diluting everyone down.
Cool, and have our two entrepreneurs have got any experience of using introducers?
I've used corporate finance before with mixed success.
Okay.
If I'm trying to get an introduction to the UK VC market, their answer is, I'm right with you. You just go direct. You use your board for that, because often you've got existing investor, they have their own network, and off you go. However, we did use one at Oxensus where we wanted a corporate investor.
Yep.
And it was a corporate. So here was a business that dealt with power generation and aerospace. We end up getting an investor from Germany, from one of the private families, hadn't come across the radar, and they dealt in industrial instrumentation. Perfect. They had markets we didn't have access to or didn't understand. We had the technology they wanted. It was a lovely match. We would not have got that from our own workings. It just wasn't available. So that one was a success. I've had it where we've used the banking almost to prove a point. We had to go out and use a corporate finance to make sure the market was thoroughly searched.
Yep.
That was a fail.
Okay.
So that would be my view.
We haven't. I think we've used our network. So we'll work with sort of professionals who've raised money before, so raised VC funding before. But really, for us, we've looked at it. We've looked at corporate finance advisors, but given our stage of being sort of Series A, we haven't gone for it. But we have brought in people who've had prior experience of, so it'll be the CFO of a business who's successfully raised funding before, just to get us through the ropes. But also what's really important, for us that's been more important, is having really good lawyers as well. So we have not in-house counsel, but we have someone who really understands our business, understands the technology, and a really good relationship with them. So when we're negotiating with whether our large customers or, you know, sort of investors as well, in terms of, you know, getting through due diligence, they're an incredible asset, so use them really well. But not just traditional lawyers, people who really can understand sort of some of the corporate finance stuff, some of those corporate challenges, rather than just pure legal challenges.
Fantastic. I'm going to come to my final question. I'm going to pre-warn you what it is. There is no pre-warning. I'm going to warn you what it is I want you to imagine that you've gone back in time to when you started your entrepreneurial life. What do you wish you knew? While you're thinking about that, I'm going to remind the room that, of course, for introductions or to know where the grants are, you can use Innovate UK Business Connect as a source of information. Who would like to take the first question on advice to the younger self?
If I look back, most of the companies that have gone well know what their sales pitch is. The technology follows. And it's, even there, it's boiling back down to, if I'm selling something, be it a sensor, be it software, be it waste, why will the next person buy it? And is there a need? It's often spoken about need versus want. But it is. Large corporations rarely move because they want something. They will get out of bed if they need something. You want a good example? Go talk to Boeing about things blowing out the planes. They're moving. It's harsh, but that's it. But a lot of the companies I find, I have an idea, I have a technology, but who's actually going to buy this?
Market pull, then. That's a big vote for market pull.
So I would say to my younger self, prioritize your time, because, you know, and one of the questions sort of I ask people sort of in the management team is do this mental exercise of what is your time worth? Is it £15 an hour? Is it £1,500 an hour? Is it 15K an hour? Because actually, as the founder or the senior management team, you need to be focusing on the problems that only you can solve. you can't be focusing on, you know, the £15 an hour problems, because you're just losing the business money hand over fist. You know, that's 30K a year. If it's, you know, £150 an hour, that's 300K a year, approximate terms, in terms of what your turnover is worth, what your value you're bringing to the business. So you've really got to be solving the problems that are £1,500 or 15K an hour worth. And really, sort of, what does that mean? So it's, some of it will be, you know, prioritize three things of like cash flow, just have positive cash flow because it makes life so much easier. So prioritize that, prioritize getting customers on board, really, really getting customers on board, and your future funding. But spend time on those problems rather than those little problems that, and it's not trivializing things, because there are lots of really important jobs, but your job should be the value add that only you can do. And it's having very deliberate practice to focus on that.
Otherwise, you save money in very expensive ways.
Perhaps focusing on the things that could have real and significant impact. So it's easy to spend a lot of time reviewing and even getting involved with really interesting, but things that are unlikely to take off and are unlikely to really move the needle. So for me, a really important thing is the urgency of climate change, and you know, one of the best things we can do with that is focus our resources and our time on things that are really going to significantly move the needle in terms of greenhouse gas emissions. So you have to be quite brutal, actually, with saying no quickly to things that are, you know, just not going to move the needle. And focusing on the things that are going to have, you know, we have a threshold of 0.5 gigaton greenhouse gas emission reduction per year by 2050, and it's a really high bar, but I think it's good to have that.
If you're going to do something, make sure it's big enough to be worth doing.
Exactly.
Thank you. Nicola, would you give us our final piece of advice to the younger you?
Yeah, I'll try. I don't have anything particularly profound, unfortunately, but I think what I would say to myself is maybe ask for help a bit earlier. So I think sometimes just by sharing that idea or that problem a little bit earlier, you can kind of move it forward much more quickly, and maybe in ways that aren't expected. Not just by talking about the problem, but talking about why you want to deal with that problem. I think that can be really galvanizing to people in terms of the advice they help you with, the connections they make for you. I think that's really helpful in something like a startup where it's fundamentally about people and your relationship with those people that are backing you, even if they're not in the company or investors. You've got to sort of need a cheerleading group around that business, and getting them to help you earlier on can be really, really powerful.
Thank you, Nicola. That brings our time together to an end. I'm going to urge you to say thank you to the panel. They've been wonderful in sharing their thoughts and insights. If we could please show them some appreciation, I'd really appreciate it. Thank you, folks. I'm sure we're going to be here taking questions to ask the questions you didn't want to ask in public. Thank you.